Assalamu alaikum. Welcome to lecture 2 of ATX. Today's topic is employment income and related NIC. So, in my earlier lecture, I have finished the pro forma and all the various types of income on which income tax is charged. Out of all those type of income, one sort of income was employment income, which comes under non-savings. By the way, if you haven't watched my lecture one, please go and watch it. It's in the ATX playlist. So coming back to this lecture, so employment income in itself is a big wide topic. Under this, we have various sort of income. Okay. And the way how each income is calculated and how it is taxed varies. But overall together, all the types of employment income, aggregate them together and charge the income tax on it. Okay, but we need to know the what employment income is made up of. It's made up of several types of income. So here we are going to focus on, and let me give you an advice that this lecture is going to be very lengthy because the slide itself is 124 slides. Okay, this is a very big lecture, so make sure that uh, you keep your patience and watch this lecture till the end so that you get the maximum benefit out of it rather than skipping this video in the mid or in the beginning. Otherwise, you will miss out the important things which might be towards the end. So let's start. Employment status. Before even deciding the income, one needs to know whether you are an employed or self-employed. This difference you have to understand very properly. Okay, because if you are employed, then it comes under employment income. If you're self-employed, your income will be under self-employed income. Next, calculation of employment income, very important. We have a pro forma for it, which we are going to study. Then, reimbursement of expense by employers. Often employers do that. They reimburse their employees for the expenses. How you will account for it? Then, employment benefits, not only in cash. Employees might receive benefits in kind, that means other than cash. These are non-cash benefits. Company car or a loan or a house or leave, sick leave, like that. How do you account for it? Even this comes under employment income. And there are various types of benefits. Most of this are tested till employment benefit. Employment status, calculation of employment income, reimburse, and employment benefit was tested in your taxation, F6 level. So it's nothing new. It is just a revision, quick revision. For those students, it will be very helpful if you have come to ATX through exemption. For example, you haven't done taxation because due to your courses you got exemption. So if you're new to ATX, this is a very good revision for you because you don't have to go back to F6 and study back again and then come to ATX. No, it's a absolute time waste. Don't do that because even I was an exempt student. I directly went to ATX. Okay. But for those students who have done taxation and who remembers all these rules, employment status, how employment income is calculated, the employment benefits, uh, and you remember it very well, no need to waste your time. You can quickly jump from share scheme onwards. Why share schemes? Because share scheme was not there in the taxation level. This is something new which will be tested in your ATX. It is included in ATX. Okay, from here onwards, share scheme. Then next, tax advance share option and incentive schemes. This is not there in taxation. It's here in ATX. It's new. This is new for both taxation and ATX students. Then lump sum payments on termination or variation of employment. When you change your employment contract or when you leave, terminate, when employees are terminated, they are paid some compensation or some lump sum payment. How it is accounted. These are new. So this you need to focus your attention. Then NICs, National Insurance Contribution. National Insurance Contribution has been taught in taxation. So it's not new, but it's a quick revision because remember, even in your ATX, you can be tested your taxation knowledge. Okay, it's a prerequisite that you have to know your taxation knowledge very well for ATX. But in depth, your taxation knowledge will not be asked in depth. Like they will not tell you to calculate a full employment income table like that, no. Or testing all the benefits, maybe one or two benefit out of the list. Even for the share schemes, there are various type of share schemes. They might just ask one or two, not all the share schemes. This is not a knowledge based paper, this is a professional level paper. So mostly they will ask for your advice or your recommendation or some kind of solution to a problem. That's it. They will not tell you to. So the focus is not on calculation so much. It's balanced. Calculation plus your recommendation. Okay. National insurance contribution we have for self-employed income. That's my next topic. By the way, in my next lecture I will follow. There also you have NIC. So national insurance contribution has been broken down into two part. One is for employed, one comes for self-employed. So now, and then the summary. But under each topic we have a small summary so that we summarize. Okay, for example, NIC, there's a small summary. Share scheme, there's a summary, like that. Small summary, and then finally the big summary of this whole lecture. And in between we are going to have questions. Okay, questions that was there in your Kaplan textbook. This lecture I've taken from Kaplan textbook, by the way, ATX textbook, the latest. If you don't have, please do not hesitate to email me at accssabiakhtar@gmail.com and I will give you the link of the textbook and the revision kit. Well, revision kit, I don't have the latest revision kit till now, but textbook, yes. Make sure that you have the textbook. Okay, because you will initially start with the textbook. By the time you finish your textbook, maybe one chapter at least, I am assuming your revision kit will come soon. I haven't received the revision kit yet, the latest. That's why I'm not able to give it to you. But yes, textbook is there. And make sure that you have the latest textbook. That is from June 2024 to March 2025. And Kaplan is the best. I don't recommend BPP textbook for taxation and advanced taxation. But other subjects, any book is fine. Now, starting with overview. So the overview of this lecture is how your earnings will be assessed. First criteria, employed or self-employed. We have some factor to determine that. We'll go through that factors. We have went through that in taxation. This is a quick revision. Next, salary. So the most and basic everyone knows under employment is your salary. This is the first. So from your salary and benefit, you add your benefit with salary and deduct all the deductions. What are these deductions that you can deduct? What are the deductions you can't deduct? For that also we have a list in this lecture. Next, share scheme. Share scheme also comes under earnings. Then redundancy payment comes under earnings. It's a sort of earnings. Then NIC is also earnings. And NIC, here actually there are 4 classes of NIC. Class 1, Class 1A, Class 2 and Class 4. Okay. We are only going to study Class 1 and Class 1A because this is only for employed. Class 2 and Class 4 are for self-employed. For employed is only Class 1 and 1A we have to worry about. Even Class 1 is divided into 2. One is for employer, one is for employee. But Class 1A is only employer. So out of all this, employee only has to pay Class 1, employee, NIC. We'll understand this at the end of this lecture because NIC is the last topic of this lecture, the subtopic. So now, distinction between employment and self-employment. Very important. You can't go wrong here. If you go wrong here, everything becomes wrong. Why? Because employees, they will be taxed on their employment income. Okay, and self-employed, how they'll be taxed? They'll be taxed on the profit that they get from their trade or their profession or their vocation. Okay, so that falls under the rule governing trading income, and for employees fall under the category of employment income provision. It's 2 types. Okay, don't mix employee with self-employed. It might look like both are profit, both are non-savings income, but no, there are differences. So now, this is very frequently asked. What are the factors to determine self-employed from employed? So now this are the factor. Factor number 1, obligation. You have to see the obligation. I have highlighted it in bold so that you know this factor. Number one factor is obligation. What is the obligation? See, employees are always obliged to follow the employer's command. They can't decline the work as they wish. Employers, on the other hand, if they want, they will work. If they don't want, they can maybe postpone it or decline the work. So employer can decline, employee can't decline. That's the difference when they are offered the work. Second factor, control. Who has the control? It is the employer. Employer can control the manner and the method of work. Employees can't, they don't have a say. Third, fixed hours. Employees, they have a fixed hour in their job description, right? 9 to 5, for example. Employers can work anytime. Fourth, integration. See, the work that is performed by employee, it's a part of a business. It's an integral part of a business. Okay? It needs to be done. But for employers, it's not. It's not an integral part of the business. Fifth factor, risk. Who is bearing the risk? See, if employees are not paid their regular salary, it's a risk for them. But employees don't face that, right? If employees are not paid an agreed regular remuneration, it's a financial risk for them. So who is bearing the risk? Employees. Employees, on the other hand, also has a risk. Their risk is separate. Their risk is not of not being paid a salary. Their risk is, what if they don't get a profit from their business? That's their risk. So the risks are different. Then the sixth factor, equipment. So the use of the equipment can be a useful factor in determining the employee status. Then seventh is the rights. See, employee, they have a right to receive a regular remuneration, holiday pay, redundancy pay, or benefit. Employees do not have all this. Employees, from whom will they take this redundancy pay? From whom are they going to receive the holiday pay? They don't have any right. Then, eighth, source of work. Employers have different sources of work. Employees only have one source of work, source of income. That's their job. Then the ninth, in substitute. Remember, employees, they cannot substitute someone else to do their work. They have to perform the work for which they are hired. Employers, on the other hand, they can substitute someone else. So how many factors are there? Total 9 factor. 9 factor. Remember this 9 factors. Okay. Next, how income tax. The difference between self-employed and employee, the employment status. So income tax on self-employed, it will be charged on their trading profit. Current year basis. Okay. In the current year, what is their trading profit? Then expenses will be expenses which you can deduct from the trading profit, which are wholly and exclusively for the purpose of your trade. And for employees, it is on receipt basis. When you receive your income, when you receive your salary, when you receive your bonus or your commission or your benefit. Expenses, wholly, exclusively, and necessarily. One more addition is added for employees, that is necessarily. Wholly exclusively is there for self-employed also, employee also. But necessarily, this word is added for employee. That means any expenses that has been incurred by an employee that is necessary for the performance of the job, you can deduct from your employment income. Next, payment of income tax. For self-employed, self-assessment, and for employee, it is monthly. How? Payee by payee, pay as you earn. Remember, income tax from employees are deducted from the source. Before employees receive the employment income, tax has already been deducted from that. Tax is deducted and then they receive the income. But for self-employed, they have to do their own self-assessment of income tax. And then they have to pay the income tax. NIC. Self-employed has to pay class 2. That is flat weekly rate. See, this weekly rate is fixed. It's a flat rate. Every week they have to pay. This we'll study in the next lecture when we study self-employment income. What is that NIC? Then class 4, based on profit. This is based on profit level. Employees only have to pay employees class 1, only one sort of NIC. This is based on their cash earning. Based on cash earning. That means benefit will not come here. For benefit, we have another NIC. That is class 1A. Remember the start of this lecture, in the overview I have told you NIC class 1 and class 1A, that one is for benefit. All the benefits on benefit, the national insurance contribution you have to pay is on class 1A. Because in UK, everyone has to pay this national insurance contribution. Everyone. You might not find this NIC in like in Southeast Asia or the Middle East. No, it's not there. It's there in UK. It's there in European countries. Right? That's why we have to study this NIC. Now, how these NICs are paid? Class 2 and class 4 NIC will be paid along with the income tax. And here also NICs will be monthly for employees. Then pension. Self-employed have personal pension only, but for employee options are there. They have both occupational and personal pension scheme. Both they can do or one of them. But for self-employed, only personal pension scheme. Next, VAT. Self-employed, they have to register. They can reclaim the input VAT that they have paid. But employees are the one who suffer the input VAT. Okay? They suffer the input VAT. They can't reclaim. It's the employers only or self-employed, they can reclaim the input VAT. Next. So this is a pro forma for what? For employment income computation. First, salary. Second, bonus or commission. Third, benefit. Fourth, reimbursed expenses. Even this is a sort of income. Then, cash vouchers. All allowable deductions you deduct. Then, allowable deductions are what? These are the allowable deductions. Expenses incurred wholly, necessarily, and exclusively. Contributions to employers' occupational pension scheme. Okay. If employees are making any contribution to the employer's occupational pension scheme, it's an allowable expense, you can deduct. Subscriptions to any professional bodies, you can deduct. Charitable donations, deduct. Travel and subsistence expense, deduct. Deficit or mileage allowance, deduct. Cost of partnership shares acquired in a tax advantaged SIP. Okay, that is share investment plan. Share incentive plan, okay? That is the meaning of SIP. All these are allowable deductions. Please make sure that you know this list. Out of this list, one or two might come, if not the entire thing. So these are the allowable deductions. You can deduct it and get your employment income. Sometimes, not sometimes, in fact, most of the time, if you are given a list of deductions, there you will be given some deductions which are not allowable. So make sure that you read line by line and don't include everything under allowable deductions. Some might not be allowable. So make sure that you know. Anything from this list comes in your exam are allowable deductions. Next, we have further. This is not the end, okay? After this, after deducting allowable deductions, add any redundancy pay. Then deduct exemption. Then add non-tax advantage share option plan on exercise. We'll go through the share skips later on. And then you can come back again and go through this pro forma once again. And finally is the employment income. Okay. Next. What is the basis of assessment? It's a receipt basis. Okay. Whether you are a director or whether you are an employee. See, even directors are also employees only. Okay. They're high level, high skill employees. So directors and employees, they are taxed on the amount of earnings received in a tax year. Receipt basis. Earnings. See, earnings includes cash wages, salary, bonus, commission, benefits. Next, we'll go through these earnings, okay? First is the state benefit. The state benefits are subject to income tax, statutory sick pay, statutory maternity pay, retirement pension and bereavement benefit. See, earnings can include amounts paid for services that have been performed in the past or that will be going to be performed in the future. For example, you have received an earning, cash amount. Either it might be for a service that you have already delivered in the past or you're going to deliver in the future. Whatever it is, it's earnings only, amount that you have received. Third party payment. This is also earning. Okay. For example, this sort of payment means any payment that a person receives other than the employer for the service that the person has performed. For example, you have went to a taxi. Okay, taxi driver receives a tip. Tip might not be their normal fee, it's something beyond their normal fee. Taxi driver might receive their fee for taking you to a certain place, but you have voluntarily decided to give them a tip either to a waiter or a taxi driver. So what do you do with this tip? See, this tip that has been received by the taxi driver or a waiter are charged to income tax. That is the meaning of third party payment. Why? The taxi driver is not your employer. Sorry, you are not the employer of the taxi driver. They've received a payment, so it's a third party payment. That tip. Next, golden hellos. What is golden hellos? See, no one is going to ask you in your exam what is golden hello, but knowing the meaning is good. A payment that is made to an individual to induce them into the employment. You want them to bring them to the employment. Okay. So for that, if you make any payment, that will be taxable. Unless it's a compensation. Okay. Unless it's a compensation that you have paid for giving up something. You are giving them a compensation so that they leave their current job and come to your job. Then that compensation that you are paying, that amount will not be taxable. Otherwise, any payment will be taxable. That's known as golden hello. Then, golden handshakes and restrictive covenant payment. What is the meaning of this? Any payment that you made to an employee, okay, because why you want to restrict them from certain activity. That's why you're giving them this payment. For example, you are giving a payment to employees saying them that you can't work for a competitor. Within this period, for example, you have just left a company and you are telling your employees who is going to leave that within 5 years or within 4 years, you can't work with a similar competitor, our competitors, for a set period of time. And you are giving them some payment for it, a big amount. That payment is known as golden handshakes. Okay, or restrictive covenant payment. You are restricting them. Next, the receipt basis. How do you determine the receipt basis? See, the date of receipt, how do you decide it? It is the earlier of these two dates, the actual date of payment or the date individual becomes entitled to the payment, whichever is earlier. And in case of director, there are some more rules. Why? See, directors are in a position to manipulate the timing of the payment, right? That's why there are most rules for them. So these are the extra rules. For directors, there are 4 dates. Earlier of the 4 dates are known to be the dates that they have received their earnings. First one, actual date of payment. Second, the day individual becomes entitled to the payment. This two was there before also for any employees. Now these two are added. When some on account of earnings are credited in the accounts, and the fourth, where earnings are determined. Earliest of these four, whichever is early, is the date that you have received your earnings. So where the earnings are determined? If your earnings are determined before the end of period of account, end of that period is your receipt basis. And if it's after the end of period of account, it is equal to the date the earnings are determined. Okay. Now, let's do a question before we move on to the next subtopic. Test your understanding 1. Here we have to advise when this bonus will be taxable as an employment income. So we are working out which portion of the syllabus, receipt date, right? We want to know which is the receipt date. Why? Because employment income are taxed on receipt basis when you receive it, and there are certain criterias, right? So he is a director of the company, okay? And for the directors, there are four rules. Normally, for all employees, there are two rules. For directors, there are two additional rules. We have just seen in the previous slide. So we are going to apply it in this question, exactly the four dates. Okay. What are the four dates? Actual payment, when they are entitled to receive it, when it is credited in the accounts, and when the bonuses are determined. Okay. So here, earliest of the 4 days will be taken as a date when you have actually received the bonus, and on that date only bonus will be taxable, right? So when was the actual payment done? See, they have received a bonus of 25,000 on 1st September 2023. Here amount of bonus is irrelevant because the question is advised when the bonus is taxable. It's about the time, the date. So actual payment was 1st September 2000. So I will write it somewhere. Actual payment was 1st September 2023. Next, it was credited in the accounts when, see, these results are for the year ended 31st March 2023, but he have received late, and it was credited in the accounts on 15th July 2023 following a board meeting on 30th June 2023. After the board meeting, so when was it credited in the accounts? 15th July. Next, when was the bonuses determined? See, you have to see whether the bonus were determined before the year end or after the year end. Okay, if it was before the year end, then you have to check the date when it was determined. And if the bonuses were determined after the year end, you have to take the year end. As taxable. Okay, so here, see, the bonuses were determined on 30th June 2000. On this date, it was following a board meeting. So in the board meeting, they have determined that this will be the bonus, right? 30th June. And this 30th June is after the year end, after 31st March 2023. It's after the year end date. So because it's after the year and date, bonus determined will be this date itself, the later date, after year end date you have to take, because it was there in the previous slide. If you have not understood it previously, now is the time for you to understand. They have clearly mentioned that if it is before the year end, okay, if bonus were determined before the year end, then you have to take the actual date when the bonuses were determined. But if it was after the year end, like in this case, year end is when 31st March, bonuses were determined 30th June, which falls after year end. So that after year end will be the date when bonuses were determined. Like how here we are taking 30th June, not 31st March. Understood? So now if you compare these three dates, you have to check which one is the earliest. Is it 1st September, 15th July, or 30th June? It's 30th June, right? So 30th June is the answer. Bonuses will be taxable on 30th June 2023 because this is the earliest of the three dates. Let's move to allowable deductions. Okay. There are some deductions that you can deduct from your employment income. Some expenses you can't deduct. So let's go through the allowable deductions. Allowable deductions means from your employment income, you can deduct this expenses before calculating tax. So traveling expenses is one such expense. Traveling expense you can deduct only where they are incurred for the performance of your employment duties, or it is necessary to attend those work, okay, at the place by the employee. So any work performed at any place by the employee, any expenses incurred during that process in that place is allowable expense. You can deduct it. And remember, relief will not be given for those cost of journey which are just ordinary commuting or the cost of private travel. If you're traveling anywhere for your private purpose, not business purpose, not for your employment purpose, you can't deduct it. And ordinary commuting. What is ordinary commuting? Ordinary commuting means any journey that you make between your home to your permanent workplace. Every day you'll be making it. So that expense you can't deduct. Next, private travel is from your home to anywhere else other than your workplace. Next, but relief can be given for employees who works directly from home to a temporary place of work. Okay, if you're traveling from your home to a temporary place of work, relief can be given. That means you can deduct. What does this temporary means? A temporary workplace is one where an employee performs a task for a limited duration or for a temporary purpose. What is this limited? What is the duration of this? How do you decide it's temporary or not? Any idea? Okay. So, a place of work will not be called as a temporary workplace where an employee works more than 24 months. That means for it to be called temporary, it has to be less than 12 months. If a work is expected to last more than 24 months in a place, it does not come under temporary, then it becomes permanent. 24 months means 2 years. Less than 2 years is temporary, more than 2 years is permanent. This is how you decide. And an employee needs to work continuously, okay? I'm talking about continuously working for 2 years or less than 2 years. Not someday you work, someday you don't work, not like that. Okay, next. But let's say an employee passes the permanent workplace on the way to a temporary workplace. Still relief will be given, provided the employee does not stop at the normal workplace or any stop is incidental, let's say to pick up some papers. So if let's say you have just passed your permanent workplace to go to the temporary workplace from your home, still a relief will be given. Okay, but remember, if the employee's journey qualifies for the relief, I'm talking about business journeys only, not private journeys, then amount of relief will be the full amount. Full cost of that journey is the amount of relief. There is no partial in that. So there is no need to take account of any savings employee can make by contributing towards the cost. Okay, or let's say employees have decided that they are not going to communicate from work to from home to work. Again, employees can't save anything. Okay, they will be eligible for the full relief. The relief is the amount of the full cost of that journey. Now, approved mileage allowance payment, AMAP. So still we are in the travel expense, right? We haven't touched any other expense. Slowly I will move towards one expense and the other. Still we are in the mileage allowance. Why? Because it has certain rules. Okay, this one, and often this is tested. So employees, let's say, who use their own vehicle for work, they will be given a mileage allowance. Okay, and this mileage allowance is set. This is how it is done. Okay, these are the rates. So for car and vans, first 10,000 miles 45 pence, over 10,000 That means let's say 15,000 miles you have traveled. So first 10,000 is 45, the balance 5,000 is 25 pence. Then passenger rate is 5 pence, motorcycle 24 pence, bicycles 20 pence. Okay. Often you are tested on the cars and the van. Okay, most of the time. Now, the car and the van rate, they are not given they are given in the examination, but not the other rates. That means the bicycle, motorcycle, passenger, they are not given, but car and van rate are given. The first two, that is 25, that is 25, 45 pence and 25 pence, they are given. Now, let's say you have received the mileage allowance within the rates, then no taxable benefit arises. So let's say what happens when the mileage allowance that an employer receives is more or less than these rates. So let's say mileage allowance that you have received is more than the AMAP rate, then the excess will be taxable because you have received more. But if you have received less than the rate, okay, or no allowance you have received, then the difference is allowable deduction. You can deduct that, the difference from the AMAP rate to the mileage allowance that you have received. However, no deduction claim you can make on the passenger rate, okay, for the passenger rate, if it's if you're receiving less than 5 pence. If you're receiving less than 5 pence, you can't make a deduction claim for the shortfall. That option is not given to you. Like how mileage allowance, if we receive less than the rate, we can do a deduction claim. We can deduct it as an expense, but not for the passenger rate. If we have received less than 5 pence, the deduction claim we can't do with the difference. Now, so let's summarize the employment income. Okay, so allowable deductions. So allowable deductions, an expense needs to be incurred wholly, exclusively, and necessarily for the purpose of that work. Then only you can deduct. If it's not wholly, if it's not exclusive, it's not necessarily expense incurred because of that job, you can't deduct it. Very simple. Next, contributions to the employer's pension scheme. Employer's pension scheme. Any contribution makes, you can deduct. Subscriptions to professional bodies, you can deduct. Travel expenditure, you can deduct. AMAPs, you can deduct. Then under travel expenditure, needs to be performed for the performance of duties only. That means whatever travel you are doing is only for the performance of duty, not any other purpose. Then relief will be given to travel to temporary workplace. No relief for ordinary commuting. Ordinary commuting means from your workplace to your home. Sorry, home to workplace or workplace to home. Private travel, no relief. And so do not reduce travel to temporary workplace from travel from home to normal place of work, okay? Don't think they are same. When you're traveling from home to your normal place of work, that's different, and home to temporary workplace, that is different. Do not confuse the two. They're not the same. AMAP. Okay. So this you will be given if you're using your own vehicle. Okay. It's a tax-free mileage allowance. If you have received the mileage allowance more than the AMAP, excess is taxable benefit. If you have received less than the rate, difference is allowable deduction. Now let's do a question. Test your understanding too. Here you have been given the mileage allowance at two different rates, okay, and you have to calculate whether it's a mileage, like it's an allowable deduction or a taxable benefit. Okay, so here Lotte uses own car for business purpose, okay, drives 12,000 business mile, for which he has been paid 20p per mile. Okay, but Lotte is also taking a work colleague along with him. Okay, so he's a passenger basically, so for which she is going to receive an extra 4 pence per mile. Okay. So he took a work colleague on some business trip totaling 5,000 miles. Well, that is not very important. What is important at this, that this is a passenger rate. This is what you have to understand. This is a passenger rate and the other ones are the car rate by the mileage allowance. So you have to calculate the taxable benefit, either a taxable benefit or the mileage expense claim for the tax year 23-24, assuming Lotus employer pays a mileage allowance of 20 pence per mile, B 50 pence per mile for the car. So let's quickly do this. Okay, now A. First, always calculate the mileage allowance. Okay, mileage allowance claimed. This is how you start always. Okay, so how much you have driven? 12,000. And how much employees are paying? 20 pence. 20 pence when you're taking, okay, writing it, it's 0.2. Okay, in terms of pounds, it is 0.2 because one pound is equal to 100 pence. So 20 pence will be 0.2 just divided by 100. You will get it in terms of pounds. Remember, we want the answer in pounds. So this is pence. Whenever you are given pence, don't forget to convert it into pounds. Okay, because we are always working in pounds, not pence. So it will be 12,000 into 20 pence. It will be 2,400 pounds. This is how much you have received. Now your job is to see whether you have received more or less than the allowance, the rate A M A P. Okay. According to that, the first 10,000 will be at what rate? 45 pence. How much? 4,500. Next, balance 2,000 is at 25 pence. How much? 500. So if you check this both, it's 5,000. 4,500 and 500, if you add, the total is 5,000. That means you have received less. You have received 2,400. You have received less than the AMAP. That means the difference you can, it's an allowable deduction. You can claim. Okay. So this is an allowable deduction. It's not taxable because you have received less. So you can claim the difference. How much? The difference between these two. This is 5,000, this is 2,400. So 2,400 minus 5,000 is 2,600. 2,600. This is how much you can claim in A. Part B, everything else remains the same. This will be 5,000. Just change this to 50 pence. So then it becomes 6,000. So you have received 6,000. The rate is 5,000. You have received 1,000 more. Can you see that? So because you have received 1,000 more, this is now a taxable benefit. The excess needs to be taxed. You have received more than the AMAP. And what about the passenger rate 5p? So you have received 4p, right? This is less than, this 4p is less than 5p, the passenger rate. This is tax free. Okay, it is tax free. But remember that 1p, 5p minus 4p, the shortfall 1p, this you can't claim. Okay, you cannot make, you can't claim this shortfall. The next subtopic is reimbursement of expenses by employers. When employers are reimbursing for the expenses to the employees, how it is dealt with. So when an employee is reimbursed by the employer for the expenses, the amount received by the employee is a taxable income. However, an employee can claim a tax deduction for the business related expense. Some expenses are partly allowable and partly disallowable. For them, that exemption can be applied to the allowable part only. Okay, for example, let's say an employee's home telephone bill is fully reimbursed by the employer. So that exemption can only be applied to the business call, not the private call. Okay. Reimbursed expenses which are not exempt. As we have earlier seen, there are some expenses which are exempt, okay, and some which are taxable. So you might be reimbursed for an exempt expense also, taxable expense also. So if you are reimbursed for those expenses which are taxable, that means which are not exempt, you have to report this to HMRC using a form P11D, form P11D, and include them in the employee's tax return because you have to pay tax on that. That's why this reimbursed expenses also under the income you have to add before paying tax. Okay, that's it. Coming to the employment benefit. Employment benefit is it's another subtopic under this big topic, employment income. So employment benefit, there are various type of benefit that we are going to study here. Okay, some benefits have specific rules, and for the benefits which we don't have specific rules, just follow the general rule. Okay, general rule means whatever is the cost to the employer of providing that benefit to you, that means the employees, that is your employment benefit. And for those benefit where we have specific rules like cars, accommodation, use of asset, gift of asset, you have to know the specific rules. This major of this portion was covered in your taxation. This is just a revision in ATX level. Why? Because to calculate employment income, you will be tested one or two benefits. Some benefit will be tested. Now you don't know which benefit, right? Any benefit could come from that list. That's why you have to know the rules of all the benefit. So now, first let's start with the exempt benefit before we move on to the taxable benefit, because taxable benefit is a bigger portion. Once you know which are exempt, then moving to the taxable benefit will not be so much difficult. So slowly I will touch this portion of the syllabus. Then the other portion I can quickly move on. Why? This is very big because we have lots of benefits here. I think around 10, 11 benefits. So starting with exempt benefit. Exempt benefits mean anything that is not cash, other than cash that you are receiving during your employment period. That is known as benefits. Okay, benefit in kind. Even that is taxable. So now non-cash travel benefits costing up to £50. Okay, very small item you're receiving. And the amount, if you see, it will be less than 50. Less than 50 or up to 50, not more than 50. It's exempt. Anything that you have received not in cash, but the benefit, the amount is less than 50, it is not taxable. It's exempt. Next, employer's contribution to a registered pension scheme, exempt. Pension advice up to 500 per employee. Per employee, okay? Per tax year. Exempt. Either it is provided by the employer or the reimbursement of cost incurred by an employee. Remember, this support must be available to all employees or employees of a certain category. Let's say employees retiring, nearing retirement, right? They need pension advice. So yeah, it's exempt. Medical treatment up to 500 per employee per tax year, exempt. Subsidized canteen unless part of a salary sacrifice scheme. Salary sacrifice scheme means, let's say you out of your salary only you are using, you are paying the canteen, then it's not exempt. Okay, subsidized canteen, it's for all the employees, then it is exempt. Car parking space in your workplace, exempt benefit. Then any bicycle works buses or bicycle subsidies that you are receiving for public transport are exempt. One mobile phone per employee, okay, including smartphone, exempt. Work-related training that an employee receives, exempt. In-house sports and recreational facilities, exempt. Staff parties up to 150 per annum per employee, exempt. Per annum is annually. Entertainment from a third party to generate goodwill and gift from a third party up to 250 from any source in a tax year, exempt. Welfare counseling, job related accommodation. This job related accommodation we are going to study further. Okay, we have more. Workplace nurseries that your child might get, right? Then contribution towards the home worker expenses. If you're working from home and if you're contributing, so any expenses that is being reimbursed to you. For a week, it will be £6, £6 per week, and if you're taking it in terms of month, £26 per month without documentation. But with documentation, it will be more. Relocation and removable expenses up to 8,000. Let's say you have been told to relocate, okay, and expenses is up to 8,000. It is exempt. Remember, relocation and removal expenses, this often comes in the exam, okay? Out of the exempt benefit, this exempt benefit comes. So be very careful. Exempt benefit, never put it under the benefits. But yes, you have to write it in your exam that this is exempt. If you don't write it, you are not going to get that 1 mark. You just can't simply ignore it because it is exempt. Next, overnight expenses. Up to £5 per night in UK and 10 for overseas. Okay, it's per night. Let's say you've stayed in a hotel in UK and any expenses that you are getting, okay, up to 5 is exempt. Next, employer liability insurance, death in service benefit, permanent health insurance, these are exempt. Medical insurance, treatment while working abroad, workplace charge for electric vehicles, security assets and services, okay, are exempt only when that security asset is given for the reason of employment. Then eye care test, exempt, provided this is given to all employees. Long-term service award up to £50 per year of service to mark employment of 20 years or more, exempt. Loans with a beneficial interest rate, this we have further. This loans with a beneficial interest rate will be explained further. So any loan that is less than or equal to 10,000 will be exempt, but more than 10,000 are not exempt. Okay, beneficial interest rate means you are getting this loan at the interest rate less than the market rate. That's why it's beneficial for you. That is exempt. And this 10,000 amount when you are taking, no, it is throughout the year. That means during that whole year. Let's say you are taking in installments. One employee, okay, let's say first I'm taking 2,000, then I'm taking another 5,000, then I'm taking another 3,000. So 3 loans like this you can take, 2,000, 5,000, 3,000, adding up to 10,000. After that, when you take in the same year, it will be taxed. But if that during that whole year, let's say you're taking 1,000 each time, 1,000, 1,000, 1,000, and it's less than 10,000, then the entire amount. So when you're taking that 10,000, it is the accumulated figure of all the loans that you have taken. Not at once you are taking 10,000 or less than 10,000. That's not how you check it. You accumulate and check the amount. Now, next, provision of travel, accommodation, subsistence during public transport. Let's say there is no public transport due to strikes or something. Then any travel that you have been provision of travel or accommodation by your employer, it is exempt. Awards made under a staff suggestion scheme, exempt. Next, so we are finished with all the exempt benefit. We are moving on to taxable benefit. Okay, taxable benefit if it arises by reason of employment and it is either provided to the employee or a member of the employee. Either directly by the employer or third party. It can be given by the third employer to the employee or by a third party. then the benefit is taxable. Now the general rule is this, okay? Any cost to the employer will be taxed. That is the amount of your benefit. What will be the amount of your benefit? Whatever is the cost to the employer. Next, marginal cost to the employer. If an in-house benefit, let's say the benefit is in-house, then any marginal cost to the employer of giving that benefit is your benefit. Okay. Coming to the specific rules, as I told you, some benefit have specific rules. Okay, like vouchers, credit cards, living accommodation, expense related to living accommodation, use and gift of assets, car fuel van, beneficial loan, scholarship, payment of a director's liability. This each we are going to study in depth. And out of this list, if you check the past paper, I'm not telling you to find a trend and focus that this question only will come and forget about the rest. No. Living accommodation, use and gift of assets, car, fuel, and van. This three comes most frequently. Accommodation, use and gift of assets, and car, fuel, and van. If nothing comes, but at least car, fuel, and van, the out of that car and fuel, this definitely comes in the benefit. Now I don't know what's the reason. Maybe the examiner might like that benefit, right? Because that is a benefit which is very frequently asked. Okay, even beneficial loan. So now let's start with the benefits. Before we start with the taxable benefit, let me tell you one thing. Some benefit might be available to you for the part of the year. Okay, maybe it was not available to you during the 12 months. Then what do? That taxable amount you have to time apportion. Don't forget to time apportion. If it was available for 6 months, you have to take for 6 months only. Okay, and where an employee contributes towards that benefit, what do? Let's say employee is also paying. Then what do? Employees' contributions are deducted. Yes, you can deduct it as an allowable deduction. But there is one exception. For private fuel, no matter whether the employee pays or not, you can't deduct unless you pay the full amount. There is no partial uh, contribution by employee for private fuel. It's that's allowed. Either employee pays nothing or employee pays the amount for the fuel, the full amount. Then only you can exempt. But for partial contribution of employee for the private fuel, there is no, I mean, there's no benefit. There's no saving. But when we go to the private fuel, that time you will understand this better. For now, just leave it. Next, if you are giving in-house benefit, let's say free air ticket to the employees, what do? Then the measure of benefit is the marginal cost, additional cost that you have incurred or the marginal cost, not a proportion of the total cost. Okay. Now, starting with cash voucher, that was the first, right, out of the benefit. So cash voucher, a voucher that you can exchange for an amount of cash that is greater than or equal to, but not substantially less than the cost of providing it. The amount of cash for which you are exchanging this voucher has to be greater than or equal to, it cannot be less than the cost of providing it. Let's say premium bond. Okay, so the taxable amount is the amount for which you can exchange the voucher. Understood what I mean? Non-cash vouchers. You might have non-cash vouchers. For non-cash vouchers, employees that are provided with this non-cash vouchers, they are taxed on the cost to the employee of providing this voucher. It's easy. If it's non-cash, is whatever the cost to the employer, that is the amount of the benefit. But if it's cash voucher, you have to check the amount for which you can exchange. Non-cash vouchers, let's say those vouchers which you can exchange for goods or service. Let's say retail vouchers, travel season tickets, right? They are non-cash vouchers. Credit cards. For credit card, any cost Any cost that is charged to the card for the private use by the employee is the benefit. Let's say out of that credit card, £500 employee have used for whatever purpose. It's not limited to business purpose, any purpose, personal use, and that £500 is the benefit. It's very easy. Credit card is very easy. Based on the amount of the cost that you have incurred on the cost, credit card, that's the amount of the benefit. You'll be taxed based on that amount. Coming to the next, the fourth. This is very important because often you are tested on this. Living accommodation, that's a house. You're given a house. Employees. There are two types of charge, basic charge and additional charge. Basic charge, if the amount of your house is less than 75,000. Additional charge if it's an expensive accommodation, that means more than 75,000 pounds. First we'll go with the basic charge. Higher of. Basic charge is the higher of annual. See, these figures will be given to you. You only have to calculate. Okay. Higher of annual value of property, they will give you. And also rent paid by the employer. See, if it's a property which is not owned by the employer, they must be paying rent for it. Then you have to check whichever is the higher, the rent or the annual value of property. But if a property is owned by the employer, that house is owned by the employer before giving it to employees, then you don't have to compare with the rent because he doesn't have to pay any rent. Employer is not paying any rent. So you only have to take the annual value of property. Okay. Next. That is the basic charge. Additional charge is if your property exists more than 75,000. But remember, for this additional expensive accommodation, property has to be purchased by the employer, not rented. Okay, and when you're checking the property cost is more than 75,000. So this is how you calculate the benefit. Cost of accommodation, let's say 85,000. Less 75,000 into ORI percentage. ORI means official rate of interest. Official rate of interest for this tax year is 2.25%. Remember this. Whenever you see ORI, for whatever benefit or income, rate is 2.25% only. It's fixed. For this tax year 2023-24, rate is 2.25%. Okay. So that will be your benefit. Now for the cost, what do you take for the cost? The amount that you have purchased the property at, that means your purchase price plus any capital improvements that you have made to the property before the start of the tax year, not after the start of the tax, before. If any cost you have incurred to improve that property, but it was after the start of the tax year, you can't take it under the cost and add it with the purchase price. You can't do that. Then it's an expense. So you have to check whether it's at the start of the tax year, the cost, or after the tax year. Very important are the days in tax. I've told you from day one. Now, starting with, if property is owned for more than 6 years before giving it to employees, what happens? Then you have to use the market value of the property, not the purchase price. Market value of the property when first you have provided it to your employee. They will give you in the exam. So irrespective of the market value, remember, irrespective of the market value, additional charge will only apply to a property where the original cost plus the improvement before the tax year exists 75,000. That means market value could be any amount. But when you're checking whether it exists more than 75,000 or not, you have to take the original purchase price, the cost. Purchase price plus the capital improvement and check with the 75,000, not the market value. Market value you only have to take when you have owned the property for more than 6 years before giving it to employees. Now, next benefit, job related accommodation. You have given an accommodation to your employee because it's important for your job. It's job related. Then no benefit arises. Why? As I told you, it comes under exempt benefit, isn't it? Exempt benefit, it came under that list. Then why is it under taxable benefit also? See, it needs to meet certain criteria for it to be exempt. If it does not meet the criteria for it to be exempt, it will be taxable. If the property is job related accommodation, it will not be taxed. To qualify as job related accommodation, property must be provided for these reasons. Number one, it is necessary for the proper performance of your duties. Let's say a caretaker. Caretaker needs to be in your house to look after your house. Next, better performance of the duty. Let's say it is customary for employers to provide living accommodation for the hotel worker. It's important. Third, let's say you feel that there's a special threat to your employee's security. Okay? Let's say for Prime Minister, you are giving them the accommodation because you need to protect them from the threat. So for this, whatever the accommodation they have received, it comes under job related. For job, they are being given this accommodation. That's why it's exempt. Okay. Director. A director can only claim one of the first two exemption if he's a director. What are the two exemptions? Necessary for the proper performance and for the better performance. If the director, remember, if the director has no material interest in the company, then only he can qualify, claim for the first two exemption. One of the first two. How do you check whether it's material or not? They have given the percentage, 5%. If the director holds less than 5%, then only he can claim for the exemptions. Because if he has more than 5% means he's having a material interest in the company. Okay. And the director is working full and is a full-time working director, or the company is a non-profit making organization. Under this only, director can claim the accommodation to be job related. That means exempt from the tax. Simply exempt from the tax. Now, living accommodation expenses. With that living accommodation, expense also comes. No, you have to give them heat, light, etc. So now, any expenses that is there with the accommodation, we call them ancillary benefit. Like to live in that house, you need light, you need heat, you need certain assets like furnitures and all. You just can't live in that house alone, right? Without no lighting, no heating, and nothing, right? So for on that, how do you tax? Even these are taxable. Whatever the expenses are there in that accommodation, for that also you'll be taxed. The assets that are there in that accommodation, for that also you'll be taxed. So this table, if expenses are in connection with the living accommodation, okay, and the use of asset, either it's an expense or either you're using an asset. So if it is not job related accommodation, okay, I'm sorry, there has been a mistake. Let me correct it. Yes, so the mistake was both the columns I have put if not job related accommodation. One is it's a job related accommodation, the other one is not a job related accommodation. So I've corrected the mistake. Now let's start. If the accommodation, the expenses with the living accommodation is for a not job related accommodation, then the benefit will be taxable. And what is the benefit? Whatever is the cost to the employer of giving that expenses with the accommodation. Next, if you are using an asset, okay, then the 20% rule applies. We'll later see what is this 20% rule if it is not job related accommodation. And if it's a job related accommodation, then the total benefit is limited to 10% rule. Now, what is this 10% rule? We'll see this. Okay, even for the use of asset, if it's a job related accommodation. Now, living accommodation expenses. So, this 10% rule applies to this following type of expenses only. Number one, heating, lighting, cleaning, repairing, maintaining, decorating premises, use of furniture, goods normal for domestic occupation. Then, the total accommodation benefit, it is taxed on an employee for a job related accommodation is limited to 10% of net earnings. When you're taxing it, okay, only the 10% of net earnings you are taking. It is limited to the 10% of net earnings. What is this net earnings? It is your employment income, okay, including all taxable benefit. Let's say you have 2-3 types of benefits which are taxable, including all taxable benefit other than one benefit. What is it? Living accommodation ancillary benefit. That means, why? Because that benefit you are taking here. Don't add that living accommodation expense benefit here. Other than that, all the other benefit. Next, use of asset. So when you're using an asset, employee is using an asset, okay? But who is owning the asset still? Employer. Ownership did not pass to the employee. While the employer is owning the asset, employee is using it. Then the taxable benefit is like this, 20% rule. How? 20% of the open market value when the asset was first provided. That means first made available. Usually the cost. Next, where the employer rents the asset. Asset is not owned by the employer. Let's say the employer is the asset that employee is using, it is rented by the employer. Okay, then what do? Employee is taxed on the higher of these two, rent paid by the employer or 20%, whichever is the higher. Then provision of one mobile phone. See, even mobile phone is an asset. Okay, if you are giving it one mobile phone, it is exempt. But if you are giving two mobile phone, what happens? The other one is taxable. How? Other one will be taxable based on 20% rule, because it's an asset, no? So based on 20% rule, he'll be taxed for that additional phone. Now let's do question. Illustration 1. So here you have to calculate the total taxable benefit of Kauri. This is for living accommodation. But with this living accommodation, we have expenses also. So first we are going to calculate the basic charge. Okay. Basic charge would be what? Higher of annual value or rent, since this is owned. Okay. See, the accommodation is not job related. That means it is not exempt. Okay. And the director of the Pineapple lives in a furnished company flat that cost the company this much on this date. He occupied the property from 15th June 2019. He occupied. That means it is not rented. So we have to take the annual value. Now, if you see this cost, it's more than what? 75,000. That means you have to calculate the additional charge as well. So basic charge will be higher of annual value or rent paid. So here the annual value is given 2,500. Okay. Don't get confused with this rent paid. Okay. See, this rent is paid by the employee. Okay. Employee. It is a contribution towards the benefit. It is not the rent that is paid by an employer. Here you are already given the annual value. So that will be your basic charge. Your basic charge will be your annual value. What is it? 2,500. Done. Now additional charge. Because it's higher than 75,000. There is no capital improvements or anything like that. And by the way, with this accommodation, we have a furniture along with it, which is 6,000. Also, company pays 2,000 for running cost of the flat and 1,500 in council tax. That means other expenses. And the employee pays 150 a month. Employee. But we'll adjust expenses later. First, we'll finish with the accommodation itself. So it's 1,111,111,000 minus 75,000 into official rate of interest. That's 2.25%. So when you calculate, it's 810. Add together, it is 3310. Now we'll deduct the contribution. Less the contribution by the employer. How much? 150 into 12. The rent, which is 1,800. Then we have, this is known as the accommodation benefit. which is 1510. Now we'll take the use of furniture. See, furniture is an asset. So this is a use of asset. Which rule should we use? 20% rule. 20% of the value of the furniture. What is it? 6,000. Which is 1,200. You have to add all this, okay? Then we have living expense benefit. This 2,000 running cost and council tax of 1,500, both we have to add. 2,000, 1,500. Together it will be 6,210. This is your total taxable benefit. Okay, you see there are multiple benefits, not just one. This part is accommodation. This is use of asset, and the other one are other two are living expenses. So there are three categories of benefit here. Three types of benefits, you see. So in your ATX exam also, it's not just you'll be given one type. You'll be given various types, at least 2 to 3 types of benefits in one single question. That's so when you're studying the benefit, study the benefits one by one, individually study. But at the end, make sure that you do a question where you have all the types of benefits combined in one question, because this will help you to see how far you can recall all the types of benefits that you have studied, because the rules for each benefit is different. For accommodation is different, 20% rule is different, living expenses are different, job related is different, non-job related is different. That's why. Okay. So from use of asset, we are moving on towards gift of assets. Okay. When you're gifting an asset to an employee, how do you do that? So where an employer purchases a new asset and gives it to an employee immediately, employees will be taxed on the cost to the employer. Okay, any employee contribution will be deducted. How? According to the rules below. We'll see what are these rules. But let's say an asset has been given to an employee which was used. Let's say used car or a used van or a used bicycle. Then how? And provided that it's for the work purpose, okay, then the benefit will be according to the method 1 below. Ignore the second method, only the first method. Now we'll see what are the methods. First method and the second method. First method only you have to follow. Second method, ignore. If it's a used car, a bicycle or a van, only for that benefit, not the other. So the first one is where an employee has the private use of an asset which is then given to the employee. That means gifted after using it. Then the employee is taxed on the higher of market value of the asset when gifted, market value of the asset when first made available to the employee. From there, you have to already deduct the benefit that has been taxed and the amount. If it's a used car or a used van that you are giving to an employee, only first one. Only you have to take the market value of asset when first gifted. But if it's for any other asset that you are giving as a use, like a used asset, then you have to take the higher of the first and the second method. That means I and double I. You have to remember this. Now let's do a small question on gift of assets before we move on to the next benefit. Illustration 2. Here you have been gifting an asset which is used. Okay. And the asset is a new video camera. That means we have to follow the higher of the first two method. And here you have to show the benefit taxable for on Rooney for all years. Please always read the question in tax, whether the question is asking you the taxable benefit for 1 year only or for multiple years. This is very important in any question. Years are very important. So this is for all years. When was this first provided? 6th October 2021. That time it was 2000. Okay. He was allowed to keep the camera on 5th Jan 2024 when his value was 500. How many years? 2021 to 2024, but not for the whole year because it started from October to Jan. Okay, so you can say not exactly 3 years, but a little less than 3 years. But anyway, so first tax year, this is very important, identifying the correct tax years. So when will your first tax year start from? Always check the starting date. When is the end of this tax year? So it is 6th October 2021 to when is the end of the tax year? 2000 5th April 2022, right? What do we call this tax year? You don't have to write the date like this. This is for understanding purpose. It's 21. Starts from 21, ends 22. So 21, 22. How many months? October, November, December, January, February, March. April you don't count because it's just 5 days. But October you count because it's just 6th of October. We have the whole month of October. Okay, so from October to November, 1 month, November to December, another month, December to January, another month, January to February, February to March, March to April, 6 months. Okay, and remember the 20% rule because it's an asset. With asset is 20%. So 20% of which amount? 2000. Here you are going to take 20% of 2000, but not for the whole year, only 6 months. How much? 200. Right? Next tax year will be, we know, 2022 to 23. See, this ends 24. So we have 3 tax years, 22, 23. The in between tax year will be one whole tax year. That means 12 months. So we don't have to time apportion it. Directly we can take 2000 into 20%. Because this tax year also, it is 2000 only. See, they took the camera 5th Jan 2024, the last tax year. Okay, which will be 400. Now coming to the next tax year, 23, 24. Here again you will take 2000 into 20%. For how many months? Very important. How many months? See, this starts when? This tax year starts when? 6th April 2023. Ends when? It is here. 5th Jan 2024. This falls in this tax year only. It's before 5th April 2024, right? 5th April, sorry, Jan 2023. So if you calculate the number of months, it is 9 months. For 9 months, they are using the asset. It's 300. Now, the next will be gift of asset. This was use of asset. This one is gift of asset, GOA. You need a working here. Okay? This needs a working. So I will go, wait a minute. Let me rub this so that I can create some space. Go down, keep some space, working. This is for gift of assets. This is what you have to know. Higher of the two. What is the first one? Market value at the date of gift. At the date of gift, the market value was 500. You have to compare with this, the second method. Market value when it was made first available. That was 2000, right? 2000 was the market value when the asset was first available. From here, you have to already deduct the benefits that you have taxed. Tax to date. What are the benefits? You have already done the working here. This one, and this one. For using that asset which you are now going to gift, you have already taken the benefit. You have already taxed. You can't double tax them. You can't tax them again. Otherwise, it will be double taxation. So 200, 400 and 300. If you add, it will be 900. Simply 900. Deduct and see, it will be 1100. Which of them is higher? The second method, 1100. So this will be, this figure you have to take as gift of asset here, 1100, and add this with 300 only because this is for this tax year. This is for use of asset, this is for gift of asset. 1400, this is the total benefit that will be taxable in the tax year 2023-24. See, we are in the tax year 2023-24. Okay. The next benefit after gifting of assets on the list is cars. This is very interesting, very easy to score marks, and one of the frequently tested area in your benefits. That's car. So even if you are not so confident on your other taxable benefit, please make sure that you at least know cars, because this will save you. This will save you a lot of amount of marks in your exam, trust me. That does not mean you don't have to study other benefits. No, 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 no. But car is something you have to go. In your exam, when you go, you have to go with the knowledge of this car benefit and the fuel. So now for cars, where a car is made available for private use, taxable benefit is this one. This you have to remember. An appropriate percentage you have to apply to the cost of the list price of the car. What is this appropriate percentage? What is this list price? We'll go through it now. But from that, you have to deduct any contribution that is made by employee towards the cost of the car and get the taxable benefit. Very simple. Now, list price is this. Any cost of extras is also included in the list price to make that car available. And this can be reduced by any capital contribution made by the employee. This list price can be reduced by any capital contribution made by the employee up to 5,000, not more than 5,000. Less than 5,000 or 5,000. These are the appropriate percentages. Depend on the CO2 emission and the range, driving range. Okay. For the petrol car. What about the diesel car? See, there are two types of car, petrol and diesel. If it's a diesel car and it meets the RDE2 standard, that means real driving emission standard, it is treated as petrol cars only. Even if it's diesel, if it meets the RDE2 standard, it's petrol car. You have to take the percentages of petrol car. If it's a diesel car, does not meet the RDE2 standard, it's a diesel car only. You have to use the diesel cars percentages. Now, a 2% applies to electric cars. If it's an electric car, no petrol, no diesel, electric car 2% applies with a zero CO2 emission. For hybrid electric cars, okay, that means CO2 emissions from 1 to 50. This is the range. Okay, if it's 130 miles or more, 2%, 70 to 125%, 40 to 69 miles 8%, 30 to 39 miles 12%, less than 30 miles 14%. The more and more miles it is, percentages will reduce, and if it's less mile, percentages are higher. In electric range and percentages are inversely proportionate to each other. This is the relationship you could figure out. Now, next is for petrol car and diesel car also meeting RD2 standard, percentages are same. This is the important one. See, this earlier table was for electric cars, okay, with CO2 emission from 1 to 50. You only have to check the miles and decide the percentage. But if it's a zero emission, if it does not fall from 1 to 50, percentage is 2% only. This is for petrol and diesel with RD2 standard, this table. Don't confuse the two tables, okay? Mostly this is tested, this one. So 51 to 54 grams, 15%. More than 55 grams or even 55 grams, 16%. 55 grams is 16%. Over 55 grams, you have to do a working. How? For an additional 1% increase, you add 5 grams. Okay? An additional 1% is added for every complete 5 grams, above 55 grams. If you're not understanding this, don't worry. We have questions on this. Then you will understand what does this sentence mean. Now, to calculate the additional percentage, what do you do? See, this is for the cars with above 55. How do you calculate that additional percentage? You have to round your CO2 emissions down to the nearest 5 gram. Down, not up. Then, if it's a diesel car, not meeting RD2 standard, you add a 4%. Whatever is the petrol percentage, earlier the percentages that you are given is for the petrol, 15% and 16%. For diesel, it's not given. For diesel, you add 4% to the petrol percentages if it's a diesel car. And if it's a car not meeting RD2 standard. Both, whatever it is, 4%. Maximum percentage that you can apply whether diesel or petrol is 37%. Max. So your appropriate percentage can never be more than 37%. Remember this. Okay. And this benefit can be reduced also. This is for cars only. If your car is made unavailable for more than 30 consecutive days I'm talking about, not in once in a month, it's unavailable. No. Consecutively 30 days, if it's not unavailable, if it's not available, your benefit will be reduced for that period when it was not available. Let's say 1 month, 2 months, 3 months, depending on the number of days. It will be given to you on the exam, whether it needs to be reduced or not. And if an employee makes contribution towards the running cost of the car, your benefit will reduce, taxable benefit. And remember, the benefit takes into account all the running expenses of the vehicle. Okay, that's why you don't have to, there is no additional charge for insurance, repair or car tax. All this was taken care of when benefit was taken. So that benefit, that list price was there, right? That list price includes all this additional charge with it. You don't have to do any additional charge for insurance, repairs or car tax in that list price. It takes care of the running expense of the vehicle. Now, separate benefit is for private fuel. See, the car will not operate without the fuel, right? Car is given, private fuel is also given. So for that private fuel is a separate benefit. Okay, you need to calculate it separately. And if more than one car is given to an employee, remember, for each car you have to calculate the benefit separately. Even the private fuel are calculated separately for each car. And if it's a pool car, no benefit on pool cars. Okay, pool cars means when everyone is using one car, no benefit. Next, private fuel. This is for fuel. Same percentage that you have used in the car benefit applied here, multiplied 27,800. 27,800 is fixed for this tax year. This number you can't change. Any contributions that an employee makes towards the private fuel are ignored. Does not matter whether you make contribution or not. Unless you make the full entire contribution of the fuel, then only it is exempted. Otherwise, no. Here also, private fuel also same like car benefit. It will be reduced if it's not available. Okay. For portion of the tax year. Okay. During the time it's not available, the private fuel benefit will reduce. Unless non-availability during the tax is only temporary. Okay. Now let's do question before we move on to our next benefit. Test your understanding 3. Here you have both car and fuel benefit given to you. You only need to calculate. Okay. So here, Charles took up employment on 1st July 2023. Okay. List price of the car, this is a petrol driven car. List price is 24,000. He took delivery of the car on 1st July itself only. CO2 emission is 204, more than 50. It's a petrol, more than 55 grams. So we know we have to calculate the additional charge here. Okay. Now, as a condition of the car being made available to him for private motoring, Charles paid 100. Charles paid 100 per month for the car and 50 per month for petrol. Now these are the expenses with the car: servicing, insurance, fuel, maintenance. And out of this fuel, 1150 was for business purpose. See, whenever you calculate the benefit, always start with the car benefit first. Why? You need this percentage for the fuel benefit. That's why. You can't calculate fuel benefit without the car benefit first. Order is very important. So we'll start with the car benefit first. Okay? Understand the time the car was available for use from 1st of July to end of the tax year. July, August, September, October, November, December, January, February, March. April I will not take because 5th April is the end. Okay, April is just 5 days. So this runs from 1st July to 5th April. How many months? 9 months. Benefit is available for 9 months only. What is the list price? 24,000 into 9 months into percentage. What percentage? See, it's 204. Here, this is where we have to do working to find the percentage. So this is how you do the working. You have to round down this number to the nearest 5 gram. It's nearest to 205 or 200. It's round down, or round up. Round down 200. If you round down this 204, it will be 200. Why? Why are they telling you to round down? See, when you take 204 minus 55, it will be something, a number which you can't divide by 5. It will not be divisible by 5. To make it divisible by 5 only, you round down to the nearest 5 gram. That's why the rule is like this. For you to make it flexible. Otherwise, you will get the numbers in decimals. Okay? You will not get a whole number because you need to divide it by 5. This is a working, fixed method. Whichever the emission is given to you, round down to the nearest 5. So 204 becomes 200, not 205. Don't round up, please. Then you minus it by 55. Always by minus 55 because we are finding excess over 55. Divide it by 5 because for every one change, you need to add 5 grams. Okay? And you need to add this always with 16% because this is additional rate that you are finding above 16%. And if you see, it is 45%. Remember one rule. Maximum is 37%. It can't go to 45. So percentage is 37 here. If it was 36, percentage would have been 36. If it was 30%, percentage would have been 30. But after 37, whatever the percentage, it could be 50%, 60%, 70%, it will always be 37%. But this method is fixed, okay? Always mind whatever the emission given to you, round down first to nearest 5, then always deduct 55 and always divide by 5. And that percentage always add with 16% and get the percentage. Okay, so if you do that, if you put 37 here, what is the amount that you are getting here? I will write it here once again. 24,000 into 37% into 9 months. 6660. Remember, employees have paid. Employee contributions you can deduct. How much? For how many months? 9 months. He has paid, Charles has paid 100 per month. Don't go and add 12. I know students often make this mistake. These are silly mistakes. See, the availability is only for 9 months. So 9 months, okay? 9 months only, not 9 divided by 12 also. It's per month. 9 months into 100. That means 900. Deduct. 5760. Then add the fuel benefit. Since you got the percentage 37, it is 37% into this number is fixed 27,800. This is also for 9 months. Don't keep car benefit in 9 months and fuel benefit without 9 months. Both needs to be apportioned by 9 months. Okay. 7715. Add both car and fuel, and the total is the taxable benefit. 13,475. This is the benefit. But one more question. Remember, there is no additional charge for any running cost of the car. Okay. Whatever the service, insurance, all this you don't have to take. This is why you have to know. If you don't know this rule, you might have added this also with the list price and taken tax on that. No. Even maintenance, no. But for fuel, I have ignored fuel here. Why? See, the fuel is 2,500. Okay. And he paid 50 per month for the 50 per month. See, partial contributions are not accepted. If child would have paid for the entire amount of fuel, then only you get claim deduction for it. That means there is no benefit. It will be zero completely. But since partial contribution, ignore it. Okay. Van benefit. Okay. So for van benefit, the benefit is 3,960 per annum. Okay. This is fixed. 3,960. Now for the private fuel, for the van, it is 757 per annum. These benefits are also time apportioned like cars, if it's unavailable for 30 consecutive days or more. And van, taking the van home at night, it is not treated as a private use, okay? And any incidental private use of the van is also ignored if it is not so significant. Okay, you don't take it as a private use. Next, contributions by the employee towards the van, yes, you can reduce, but not the fuel. Same like car fuel. When employees share the private use of the van, okay, let's say 3-4 employees are using the same van, what do? Then there's a scale charge. Scale charge is applied, which is divided among the employees on a just and a reasonable basis. Let's say by reference to the amount of private use. There is no van benefit or van fuel benefit for vans with zero CO2 emissions. Remember this. Now let's do a question on van benefit before we move on to our next benefit. Illustration 3. Car versus van. You need to calculate the benefit taxable on Nissan in the tax year 2023-24 for the two vehicles. And not only that, and see, there are two requirements: calculate and advise for which one she should select. Okay, so now first, whenever you have to advise, first always calculate, because without calculation you can't advise. Let's start with the car first. Car benefit. Okay, so car, we have the list price. CO2 emission is 84 and it's a petrol car. Okay, see, they have also told that he's a high rate taxpayer. Why? This is for the advice purpose. When you're advising, you need to know his tax position and certain other information. Okay. Now, the second vehicle is a petrol engine van. Same list price and CO2 emission. And Uncle will pay for all the running costs, including fuel for both vehicles. The company is going to pay. So now, it's 84. It's more than what 55. We need to calculate the percentage, but list price is there. Okay, and also fuel. This is for car. This is option 1. Option 2 is van and fuel. Because you have to advise which one. So here 15,000 into, and here 27,800 into. The percentage you have to find out. For van, no need to find the percentage. It's fixed. 3960, 757. You can get the total amount. 4717. This is the total benefit for van. For car, let's find the percentage. It's 84. Remember, in the earlier one it was 204. We rounded down to 200 because nearest down to nearest 5 by 5 grams. So it's not 85 but 80. Okay. So 80 minus 55 divided by 5, you have to add 16% to it, which will be 21%. It's less than 37, so percentage is 21 for both. No need to time a portion, it's there for the entire time. So 3150, 5838, 8988. Now tell me, which one is most efficient? It's very easy. You will always go for the lower one, the one which is giving you the lower taxable benefit because you want to pay low tax. So this is more efficient. Which one? Company van. You will advise for the company van because it is giving you the lower taxable benefit, hence saving your tax. The next benefit on the list is beneficial loan. Remember when I was going through exempt benefit, I told you up to 10,000 or less than 10,000 beneficial loan are exempted, but above 10,000 is taxable. And the official rate is 2.25%. Okay. Beneficial loan means any loan you are making to an employee below the official rate of interest. Okay. So this is how you calculate the benefit. Interest at the official rate, apply the interest on the loan at the official rate using two methods, one of the two, precise or average, and deduct interest that was actually paid in the tax year. That is your taxable benefit. Now, small loan exemption applies, right? That means small loan means loan up to 10,000 or below 10,000. Two methods of calculating. Average method, you add your opening balance with closing and divide by 2. And precise method is interest are calculated on daily basis. Okay. In your exam, calculations has to be done to the nearest month. So either the taxpayer or HMRC can elect which method they want. HMRC will only elect when it appears that average method is being exploited. Then only they will elect for which method? Precise method. Now let's do a question on beneficial loan before we move on to our next benefit. Illustration 4, beneficial loan. You need to calculate the taxable benefit using both methods. Okay, so the amount of loan was 35,000. It was granted on 31st March 2023. Interest is 1%. Okay, on 1st of June, Daniel repaid 5,000. On 1st December, he repaid further 14,000. And the remaining 16,000 is still outstanding on 5th April 2024. First, we'll use the average method. Okay. So, opening plus closing. What was the opening balance of the loan? 35,000. What is the closing balance of the loan? 16,000. Divide this by 2. And multiply the interest rate, official interest rate, 2.25%. Which is 574. From here, you deduct the interest paid. Okay. When you're taking the interest paid, you have to take the time. See, this 35,000 was paid. 5,000 was repaid, right? It was paid on 1st June. From when? 31st March to 1st June. So, April and May, 2 months. Only 2 months. So, outstanding balance was 35,000. On that, you are going to take 1% only for 2 months, which is 58. Next, the interest will be, you have repaid 5,000 out of 35. Now the balance is 30,000. Again, you are paying 1%. For how many months? It was paid on December. So from June to December. June, July, August, September, October, November. 6 months. You don't have to take December because it's on 1st of December. So 6 months. How much? 150. Next is 16,000. Balance outstanding 16,000 into 1% into how many months? Then it is from December till April. So December, January, February, March. 4 months. 53. If you add all this, it adds up to 261, which you need to deduct from 574 and get 313. This is the taxable benefit under average. Coming to precise method. This is how you work precise method, daily basis, okay? Still 35,000 into this rate, official rate, okay? Into 2 months. Next, after repaying 5,000, you'll be left with 30,000 into 2.25 into 6 months. Then you'll be having 16,000 for 4 months. 131, 338, 120. Add up 589. From here, you need to pay interest as above. What is interest? Paid. This is 261. This 261 you need to deduct. Precise method means you will calculate the interest at this rate also, you will calculate the interest at this rate also, and the difference between the two. So it is 261. Exactly the interest that you have paid using under the average method also. So the taxable benefit is 328. See which one is giving you the higher tax. This is 313, this is 328, right? So which one will students elect for? Taxpayer. 313 because this is less. No, they will elect for average method unless election is made to go for the precise method by the HMRC. So in this example, HMRC also will not elect for precise method. Why? See, the amounts are not very materially different to each other. The difference is very slight. So even HMRC will not go for the precise method. Even Daniel will not go. Both will go for the average method. The next benefit is scholarships. If a scholarship is given to a member of an individual's family, the cost of it is taxable as taxable benefit. No taxable benefit arises where scholarship is awarded from a separate trust scheme and person receiving it is in a full-time education at school, college or university. Then no taxable benefit. And not more than 25% payments made in the tax year from the scheme are made by reason of person's employment. Then it is not tax benefit. Then it's not taxable benefit. Okay. Scholarship income is exempt in the hands of the recipient, remember. Next benefit is payment of director's tax liability. Here, what is happening? Tax should have been deducted from the director's earnings. See, director is also an employee, right? Like all other employees. So even his tax should have been deducted under the pay system. Remember the pay system, how we used to deduct the employee's income? But It was not done so. Rather, the tax is paid over to HMRC by the employer, right? That time the tax was not deducted from the director's earnings under the pay system. That's why the director is treated as receiving a benefit. Okay? Who is going to pay this tax later on? This tax will be paid to the HMRC by the employer. Okay? So the benefit is the amount of the tax accounted for less any amount reimbursed by the director, if any. Remember, this rule only applies to the director. Only for directors this rule is there. Otherwise, all the employees under the pay system, their tax is deducted. They don't get this benefit. But for directors, their tax is delayed. Their tax is not paid over the pay system. Hence, it is accounted as if directors are receiving a benefit, even this for a short time. Later on, tax will be paid over to HMRC by the employer. Okay. So any benefit, that means any tax that director should have paid, less any amount reimbursed by the director if they have. Now let's do a question before we move on to our next benefit. Test your understanding 4. In test your understanding 4, you have 3 separate people for whom you have to calculate the taxable benefit. Okay. Andrea, Ben, and Chai. So for Andrea, let's start with Andrea first. Okay. So there are 4 benefits for Andrea. We'll calculate one by one. Now, Andrea was employed by the company throughout the tax year. That means you don't have to apportion anything. Okay. Now, so he was given a new hybrid electric company car with a list price of 19,400. CO2 emission is 35. Electric range is 25 miles. And the company paid for all the car running cost of the car, including petrol. Andrea pays 150 per month. Okay, this is one benefit. The next is living accommodation and also expenses with it. Remember, when you are given benefit, inside a taxable benefit, you might be given exempt benefit also. So you have to be very careful to decide which is taxable and what is not. So the next benefit is about living accommodation, which was given since 1st November 2021. It was purchased on this date for 143,800. They spent 14,000 during March 2020 and further 8,000 during May 2023. Value of the property was 170,000. Annual value is 7,000. Furniture in the property, this is asset, okay, 6,000. And Andrea personally pays for the annual running cost of the property amounting to this one. Throughout the tax year, the company pays them a mobile phone also of 500. The company paid for all the business and the private telephone calls. Next is Ben. For Ben also we have 4, and for Chai also we have the 4 notes. But before going to Ben, first let's finish with one person. See, whenever you are given multiple employees like this, better calculate one by one. Okay, so that you don't get confused among them. So let's finish with the Andrea because you don't need Ben's information for Andrea. Okay, there are 3 benefits here. One is the company car with the fuel, the other one is the accommodation with the asset in it and also expenses, and the third one is a mobile phone. So we'll deal one by one and calculate in the order given to you. It's way easier for you so that you don't run the risk of missing out on any benefit. So quickly we'll go to the car benefit. Okay, quickly we'll go to the car benefit. So let's do that. So let me write here. And with the car comes the fuel benefit. But from car, If any contribution, capital contribution, you have to deduct. Okay. What is the list price? It's in note 2, 19,400. 19,400 into what percentage? So you need to remember that table. Okay. Check the miles is 25. Electric range is 25 miles. Emission is 35. So the percentage is 14% if it's 25, because it's between 30 to 39 miles. So it's 14%, because it's an electric car range. That's why we look at the miles and decide. And the CO2 emission is not zero. So it's 2716. Then less, this is not petrol car, okay? Electric car, that's why. Less contribution by Andrea. How much? Andrea makes a contribution towards the cost of the car. Okay? He makes a contribution of 150 for the use of the car. Okay? 150 per month. That means 150 into 12. Up to 5,000 can be deducted. So this is 1,800. 916. With that, add the fuel benefit. Fuel benefit is 27,800. Same percentage, 14. 3,892. Okay. Now with this we have living accommodation. So fuel and car are over. Go to the note 3, accommodation. With the basic, add the additional benefit. What is the basic? Basic will be the annual value, which is in this case 7,000. 7,000 you can add annual value. Then we have additional benefit. For additional benefit, and also the furniture is there. It's an asset, which is 20% rule, right? 20% of 6,000. 1,200, because furniture value is 6,000. It's given here. You see, 20% rule. For additional benefit, okay, we need a working. Working 1. Okay, working 1. See, this is excess of 75,000. Okay, and you have to see whether it was there for 6 years, more than 6 years or not. Just check the date. It was in 2019. So 2021, 22, 23, 24. It's less than 6 years. So we don't have to take care of the market value and all. But remember, what is the property was purchased 143,800. You have to add any capital improvements to it. Okay, what do you have to add with it? The 14,000 that the company has spent, you have to add. Why? It was during March 2020, before the tax year. But this 8,000 you can't add. It was in May, after the tax year. Tax year ends on April 2023. I mean, sorry, 2019, right? So before April, any cost will be taken as capital expenditure. Okay, so this is the rule. 143,800 capital expense of 14,000 you can take, but not the 8,000, and minus 75,000 into the official rate 2.25%, which will be equal to 1,863. Okay, now 1,863. What about the mobile phone? Even though it is exempt, we all know one mobile telephone is exempt. You have to write it here. If it's exempt, write 0 and write a note that mobile phone are exempt. One mobile phone is exempt, even if that one is for private use. because it's just one mobile phone. So add all. Okay, that would be the benefit for Andrea. Now let's go to the next, Ben. He commenced employment on 1st of July. So from July, August, September, October, November, December, January, February, March, April. How many months? 10 months. He was employed for 10 months. Second note, interest-free loan of 120,000. It's more than 10,000. But it's interest-free. That means 0%. It's a beneficial loan. Okay. He repaid this 20,000 on 1st October 2023. See, each point has each separate benefit. They are not, this one is not dependent on this one is not dependent on this one. So even like if you have decided to do one benefit without getting confused, so since we have finished reading note 2, let's finish off with the beneficial loan before we go to the next benefit. You can do that. Okay, so now quickly we'll finish with the beneficial loan, or you can read the entire case study and then solve one benefit at a time. That's also done. I'm writing a note here. That means working, because whenever a working is required, don't put the working in the main answer sheet. Okay, keep some space for working. Working has to be separate from your main answer. Okay, needs to be written later. Note 1, working should not be in the main table. Anyway, so 120,000 was the loan. If I use the average method, use both the method. Okay, when the examiner does not say what method, use both the method and see which is giving you the lower taxable benefit. You have to choose that, and you have to repay 20. That means at the end you will be having 100,000 loan. Divide this by 2 and at 2.25% because official interest rate for 10 months. Don't forget to take it for 10 months. Okay, I'm sorry, it's for 9 months, because it was on 1st October you have repaid the loan. So from July to October, July, August, September, 3 months. I mean, sorry, from October to April, October, November, December, January, February, March. I'm sorry, it is from July. I'm very sorry, it is from July to this thing. July to April. July, August, September, October, November, December, January, February, March. Okay, April you don't take, March, so it's 9 months. One eight 56. We'll see the precise method. Okay, $120,000 at 2.25% for 3 months, because it's October. So July, wait, it is July, August, September, 3 months, because 1st October you are repaying now. So 3 months plus 100,000 into, see, this is interest free loan. Okay, that's why you don't have to take the other interest and take the difference. So even at the official interest rate, you can compare the difference. 100,000, because you have repaid 20,000, so you are left with 100,000 at 2.25% into for 6 months. Why? From October to March. October, November, December, January, February, March. 6 months. It will be 1,800. Which one is beneficial? This or this? The precise method. You have to choose the precise method. 1,800. Done. What's next? Third, it's the cost of relocation. Okay. Company paid 9,300 towards the relocation cost. Now, tell me about the relocation cost. What do you know about the relocation cost? It's note 2. See, for relocation cost, I'm not writing the note. We know the relocation costs are exempt, no? But only 8,000, up to 8,000. Excess beyond 8,000 are taxable. So you are given 9,300. Okay, so up to 8,000 is exempt. The balance 1,300 are taxable. See, some benefit, the entire excess amount are taxable. Some only the excess amount are taxable. Know the difference between these two, okay? Next benefit. The fourth note. So from 1st October to 5th April, they provide a new diesel company car. List price is 11,200, CO2 emission is 94. That means it's beyond 55. And car does not meet the RD2 standard also. That means it's a petrol only. Bain reimburses vehicles for all the diesel used for the private journeys. For all of the diesel. Okay, Bain reimburses the company. That means for all the private fuel, Bain is paying. So here, there's a car benefit. No fuel benefit will arise because Bain is paying. So only car benefit. Okay. So for car benefit, it is only for 6 months, right? They have already given you the time. October, November, December, January, February, March. 6 months. And the list price is given. But you need to find the percentage. 11,200 into a percentage into 6 months. Let's find out the percentage. Okay. So it's 94. Round down to the nearest 5. So 90. Minus 55, always divide by 5. Add this with 16%. Remember, it's a diesel car. Add another 4%. Always add 4% to the percentage of the petrol car for the diesel. This is a diesel car, that's why. So 16 plus 4 plus this, which is equals to 27%. So 27 is the percent here. This will be 1512. Done. Now let's go to the chai. The last person. He was employed throughout. No need to apportion. He was given company van. CO2 emission is 130. Van was unavailable from 1st August to 30th September. August, September, 2 months. He was also provided private fuel for the van. So let's finish with that. Van benefit and fuel benefit. See, for fuel, it is 757 fixed for a van, okay? How many months? 10 months, because 2 months it was unavailable. So 631. And for van, it is 3960 fixed. Here you don't have to worry about the appropriate percentage, list price and all this. 3960 is fixed for the van. 757 is fixed for the fuel, van fuel for 10 months. 3,300. Next, what's the next benefit? He has been given a television. Cost is 800. Company sold the television for 150. Market date was 250. Okay, this he kept for 2 years. So let's do, see, television as an asset, okay? Used asset which he gave as a gift. So for television, he will be taxed. First, how do you work this out? Tell me. See, he must have been taxed on the benefit for the 2 tax years, okay? That means 800 into 20%, which is 160. For 2 years, he has been taxed, okay? So the benefit on the sale of the television, okay? This is how you find first and the second method. First method, market value when gifted. So market value when gifted is what? 150. No, it's 250. On the day it was gifted, it was 250. So 250. Then next, 6th April. Now, when was the television first provided? 6th April 2021. Okay. That time it was, what was the market value that time? 800. It was 800 and you have to deduct what? The benefit. 160, 160 has been taxed 2 times. And also you have to deduct one more thing. What is it? The 150. The company sold the television 150. So this is the benefit on the sale of the television. It was 330. Okay. This is the benefit on the sale of the television. And if you had the television for 2 years, he has been taxed 160, 160. See, market value was 250 and he sold it for 150. Okay. The profit is 100. Which one is greater? 330. 330 is greater. So 330 will be for the taxable benefit for television. You understanding? You have to find the benefit when you're selling the television. Basically, the profit part you have to deduct from 250, that means when it market value, and from this amount, and check which is higher. So 330 is higher than this one. Now, what's next? Free membership of its health club. Normal annual cost is 800. Direct cost is 150. Fixed overhead 400. Profit is 250. What about this? Health club membership. See, this health club membership is an in-house benefit. Okay, in-house benefit are valued according to the marginal cost. So what is the marginal cost? Direct cost 150. This one. Okay. This only we have to take. Next. New computer. Okay, costing 1900 on 1st of Jan. So for how many months? 3 months only. Jan, Feb, March. You have to use 20%. So 1900 into 20% into 3 months. 95. Okay. So that's it. Tax efficient remuneration. So we have finished all the employment benefit. Okay. Now, in your tax exam, a possible scenario in your exam could be to compare the different remuneration packages. Okay, as a part of income tax planning, you might be told to compare between 2 or 3 different remuneration packages. Okay, a selection of areas to consider are whether to use your own car, claiming mileage allowance, or use the company car. You have to compare the two. Second could be comparison of tax advantage versus non-tax advantage share scheme. This is our next subtopic which we are going to cover. The tax advantage share scheme and non-tax advantaged share schemes, and using a range of exempt benefits. So these are the areas you need to consider. Now let's do a full-fledged question on employee benefits before we move on to the share scheme. Test your understanding 5. Now this is a lengthy question covering wide range of benefits. You need to comment what are the tax implications of this package. Okay. So here, as you can see, he has a car. He has an accommodation. Okay. Both options are there. Under each, there is option 1, as you can see, and option 2 for under cars. Then accommodation. Then we have telephone. Third benefit. Then, so the question is, explain the tax implications for Ibrahim arising from each aspect of the benefits package. Please. The question did not ask you to choose the best out of the option. Best remuneration package. No, 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 no. The question asked you explain the tax implications for Ibrahim. Just explain what would be the tax impact of each. Okay. You should assume benefits are provided on 6 April 2023. Okay, done. So we'll tackle one at a time. Okay, now we'll read. So Work PLC runs a nationwide chain of health clubs. Each is run by a manager who is paid an annual salary of 60,000. Okay, it has a flexible remuneration policy. With the salary, they have package of benefit which they can choose. So Ibrahim is appointed as a manager of the Workout PLC. And he's asked for your advice regarding tax implications from each benefit. If they take this benefit, what would be the tax implications? That means how much tax they can save or additional tax they have to pay because of such an option, that you have to write. Okay. Now, starting with company car. Okay, so let's read option 1. Here, new petrol car, list price is 19,200, CO2 emission 102. Immediately we know it's a petrol car, more than 55 grams. So we have to round down and find the appropriate percentage. Okay, and we'll pay for all running costs including private fuel. Even private fuel will be there. Ibrahim makes a capital contribution of 3,000 and requires to contribute a further 50 per month towards his private use. He will drive a total of this mile per month. 60% are for the performance of his duties. Okay. Whereas option 2 is Workout PLC will pay Ibrahim additional salary of 500 per month and will lease a private car. Work PLC will then pay an allowance of 30 pence per mile for business mileage. Okay. Remember, first you have to work out. So we'll quickly do the car benefit. Okay. First we'll do the car benefit. It's 102, you have to round it up. So it's a petrol. So 16% add with 100 minus 55 divided by 5 equal to 25%. Percentage is 25 less than 37, so you can take 25%. He made a list price was 19,200, made a contribution of 3,000. Capital contribution up to 5,000 can deduct. Now the list price will be 16,200. Okay. So the car benefit will be 16,200 into 25%. You don't have to apportion. 4050. Next, monthly contribution you can deduct. How much? 15 to 12. Towards the cost of the running. So 3,450 is the car benefit. Fuel is 27,800 into 25%. 6,950. Okay, 6,950. So he will be taxed on this and this. What would be his income tax liability? See, they told tax implications. Whenever they say tax implication means indirectly they are asking you income tax liability only. Add both. If you add 3,450 with 6,950, okay, 3,450 plus 6,950 into what? What percentage? What should be his percentage of tax? See, to decide this, see the salary that is getting 60,000, right? He's a higher tax. Okay, so 40%. 40% tax will be paying. How much? 4,160. This is the amount of tax he'll be paying. This will lead to having a company car will lead him to pay additional income tax liability of 4,160 because of the car benefit and fuel benefit. Okay. Next, we'll look at the cash alternative. Here they told additional salary 500 per month, right? So if you have 500 per month into how much? He will be paying how much? See, he'll be paying tax at 40% and NIC at 2%. Okay. Employee benefit, they'll be paying 2% NIC. So what happens? That means 42% they are paying. 2% NIC, 40% tax. Together it is 42%. So that means after tax 58% will be remaining, right? So 58% will be remaining. That means they'll be having a cash of 3,480 now after tax and NIC. And also mileage allowance he'll be paid mileage allowance. How much? 1,750 into, this is per month, only 60%. So mileage will be 1,750 into 12 months into 60%. Okay. How much? What is the mileage? 30 pence. Okay. Into 30 pence. How much? So what would be the mileage allowance? Let's quickly do that. $3,780. Okay, $3,780 is the mileage allowance. So now we'll add the cash salary, that is 4,160. Sorry, additional cash, right? Additional salary. $3,480. This is, and this. So if he prefers cash salary over the company car, how much? Cash 3,480. Mileage allowance 3,780. This one, okay. And what's next? Income tax relief also he will get on the shortfall. Income tax relief on shortfall. How much? See how much mileage is he driving? 1,750. It is less than 10,000. Okay, so 45 pence. So 1,750 into 12. It is how much? 21,000. And if you take just 60%, it is 12,600. So out of this 12,600, first 10,000 will be at 45. So 2,600 will be at 25 pence. 4,500 and 650. 5,150. Okay, they should receive 5,150, but they are receiving less. How much? 3,780. What is the difference? So it's a shortfall. They can claim for the tax deduction. 1,370. 1,370 is the shortfall. 1,370. But remember, income tax relief. Okay, so you have to take the tax of that. So 40% of 1,370. 548. Okay, 7808. Then total tax no longer payable on benefit. What was the total tax on this one? If you don't receive this, you can save. So 4160, 11968. This is the increase in cash. Okay. So now he has to consider whether this is enough to buy and run his car personally, this increase in cash. If it is, okay, if he thinks that with this cash he can buy his own car and use it, then it's better. Otherwise, go buy the company car. Now, next is accommodation. So here, the company will pay 7,500 towards the relocation cost. And also they pay interest-free loan of 90,000. The loan will be repaid in monthly installments of 1,000 commencing on 15th April 2023. Option 2, he will give living accommodation. Okay, the house was purchased for 86,500. This one, as you can see, is more than 6 years, and it has a rateable value of 7,700, currently valued at this is the market value. Furniture in the house is 12,400, and they pay for the running cost of 3,900. Okay, so let's quickly do that. See, relocation cost up to 8,000 is tax free, so this will be tax free and tile. It's less than 8,000. Okay, now what about the beneficial loan? 90,000. You have to work for the beneficial loan. Okay, so 90,000 plus at the end of the year, how much it will be at the end of the year? From this 90,000, for 12 months, take the interest of 1,000. You'll be paying annually, right? Monthly, like in installments. So it will be 78,000, which is 168,000. Then you divide it by 2, which is 84,000, because this is the average method we are doing. So it's 84,000, and 84,000, take 2.25% official rate of interest, 1,890. Okay, so here 1,890 is the amount of the taxable benefit from the beneficial loan. What would be the tax? If you take the tax, it would be 40% of 1,890. On this, he has to pay tax, 756. Okay. Now, living accommodation. Is more than 75,000, and you have purchased it more than 6 years before first being provided. Therefore, you have to use the market value. Okay. So here, what is the rateable value? Basic value, 7,700. You have to add the additional benefit to it, plus 135,000 minus 75,000. So you should take the market value. Let me go to the accommodation. You have to take this value, not the 86,500. Okay. Compare the market value with 75,000 and into 2.25%. Okay. Then add the furniture. Furniture is 12,400. 20% because asset you have to take 20% rule. Plus the running cost 3,900. Together if you add, total accommodation benefit would be 15,430. And if you take the tax of this, income tax liability would be 6,172. And mobile phone, remember, mobile phone is exempt. One mobile phone is exempt even if there's a private use. Because the next is mobile phone, I guess. Yes. He gives a mobile phone costing this much. And option 2. Pays 75 per month towards the cost of his fixed telephone at home. Annual cost is 1,400, of which 300 is for line rental, 650 is for business, and 450 is for private. Okay. Now, remember, from this 900, okay, see 75 per month. First, we'll do 75 per month. It's 900, okay. From this 900, you can only make the expense claim for the business call. That is only for the 650. You can make the claim, not the private and the rental. So 900 minus 650, which is 250, and apply 40% to calculate the tax implication, which is 100. You have to explain this, right? While doing, you have to explain all this, that this is only you can claim the business call, not the private call and the rental call. While writing, doing calculation, calculate income tax, you have to write also. Okay. So that's it. So since employment benefit is a long topic in itself, it's a long subtopic under the employment income, I have decided to summarize the employment benefit, just the employment benefit part out of the whole employment income. So starting with exempt benefit. This was some exempt benefit. Okay. Non-work benefit up to 50 per gift. Employees contribution to pension. Pension advice up to 500. Subsidized canteen. Car parking space. Work passes. Bicycle subsidies for public transport. One mobile phone per employee, but the additional will be charged. Work related training. Sports and recreational facility. Staff parties up to 150 per annum. Welfare counseling. Workplace nursery. Home worker expenses up to 6 per week or 26 per month. Job related accommodation. Relocation expenses up to 8,000. Excess will be taxed above 8,000. Overnight expenses 5 per night in UK, 10 per night overseas. Employer liability insurance death in service benefit. Beneficial loan less than or equal to 10,000. Above 10,000 it will be taxed. Medical treatment up to 500 per year. Now moving to taxable benefit. General rule is cost to the employer. Okay, it will be valued at whatever the cost to the employer. If it's in-house benefit, then marginal cost. Specific rule like car, fuel, accommodation, we have go through all the rules that we have covered. Always deduct employees' contribution from all the benefit except one, that is fuel. But if it's entire, like the entire amount of fuel has been reimbursed by the employee, then no benefit arises on fuel. but partial contribution by employee for fuel is not accepted. And any benefit not available for the entire year, time apportion. Now, so for specific valuation, we have this gift of asset. Okay, if a new asset is gifted, whatever is the cost to the employee is the benefit. And if first the asset was used before gifting, it is the higher of market value when gifted. Market value when first made available, less benefit already assessed. Next, beneficial loan. Interest, official interest rate is 2.5%. Okay, interest at that rate, less interest paid. Average, opening balance plus closing balance divided by 2 into 2.25%. Precise method, daily rate is applied to the outstanding balance. And in your exam, it's monthly. HMRC or taxpayers, either of the one can elect for precise method. But you have to see the conditions. Always choose the one which is giving the lower taxable benefit, okay? Out of average and precise. No benefit if total loan is less or equal to 10,000. Third is vouchers. Cash voucher, you have to see the cash amount that is exchangeable for. If it's non-cash voucher, cost to the employer. Credit cost charge to card for personal use. Then we have vehicle related benefits, cars. Appropriate percentage into the list price. Appropriate percentage is decided like this. For electric car, it is 2% with 0 CO2 emission. For hybrid electric cars, that means CO2 emission between 1 to 50. This is the table. Okay. 130 miles or more, 2%, 70 to 125, 40 to 69A, 30 to 3912, and less than 3040. Next, for petrol car or diesel car not meeting RD2 standard. Sorry, diesel car meeting RD2 standard. This is the table. 51 to 54 grams 15%, 55 grams 16. I will tell you one thing. In your exam, most of the time you will see it is above 55 grams only. Okay. Just to test your knowledge of over 55 grams, where you have to always round down the figure by 5 grams minus 55 and divide by 5 and add it with 16%. If petrol and if it's diesel, add another 4% to it. Max cannot go over 37, whether diesel or petrol. List price. Any cost of extras are also there in list price. You can deduct maximum up to 5,000 for capital contribution from the list price. And if your car is not available for 30 consecutive days, time apportion. No benefit on pool cars. Coming to fuel. Whatever the percentage you have got for car, apply for fuel into 27,800. 27,800 is fixed for this tax year. Appropriate percentage, same as car benefit. Ignore employee partial contribution. Company van, private use 3,960 fixed. Fuel 757 fixed. Unavailable, same, time apportion. Accommodation. For living accommodation, basic charge is higher of annual value and rent paid by employer. Mostly you will say annual value only you take because maybe the asset is owned by the employer. Additional, more than 75,000. Then deduct the amount by 75,000 and apply 2.25% official rate of interest. Cost is the purchase price. Any capital improvements up to the start of the tax year, you add with the purchase price. If the asset is owned, accommodation is owned by the employer for 6 years before first occupation, take the market value when first provided, not the purchase price. We have done questions also, right? We have solved all the questions on all this area, testing all the areas. Expenses for accommodation. If accommodation comes with expenses to it, cost to the employer of those expenses. Use of asset, use the 20% rule. 20% of the market value when first available. Job related accommodation, it is usually exempt. Okay. So no basic charge, no additional charge for expensive accommodation also because it is exempt. Okay. But if you are using any expenses or use of asset for the job related accommodation, that you have to take. Expense benefit will come. Use of asset from the job related accommodation will arise. But this is restricted to 10% of the employment income. Now, coming to the share schemes. From this subtopic onwards, everything is new in your ATX. This was not there in your taxation level. So, pay very clear attention to this. Both ATX students and taxation students who came through taxation needs to pay attention to this. Even if you're exempted, if you're not exempted in your taxation, you need to hear this. This may take the form of share incentive or share options. Share incentive means you are giving company shares to employee. Option means you are giving them a right to exercise the option if they want to buy company shares in the future. It's like an option to buy company shares in the future. Now, why do you need all these shares, incentives, and options? Why do you want to study it? Because you are going to get some tax advantages if you go into this. Okay, governments have encouraged incentives by giving tax privileges to these incentives, these schemes, but they have to meet relevant requirements. Okay, if the schemes satisfy conditions, they are going to have significant tax advantages. But if they are not tax advantaged, okay, then they're not going to have those advantages. So if the scheme does not satisfy the condition, it is known as non-tax advantaged scheme. If they satisfy the condition, they are known as tax advantage scheme. That's what we're going to study in this. Starting with options, share option. We all know options, right? Mostly my financial management students will know, AFM students will know. Option is the right to purchase or right to sell a commodity. Here it's shares. So share option, it means you are giving an offer to your employee today that they can purchase the share if they want at a future date at a predetermined fixed price set at the time when this option was given. Okay, but the taxation consequences of the share option depends whether the share options are tax advantaged or not. Okay, so this is how it will work out when you are giving the share option. Okay, another word for non-tax advantage is unapproved. Tax advantaged means approved. So when you are granting the option, whether it is advantaged or non-tax advantage, no tax at the granting of option. When you are exercising the option, income tax charge will arise when it's non-tax. This is how. You look at the market value at the exercise date, deduct cost of option, that's the cost of share. Okay, and deduct the cost of share, that will be your employment income. Also NIC will apply. NIC charge will be there. NIC charge will apply if you can readily convert the shares into cash. Class 1 will apply, right? Class 1 will apply whether shares are quoted. We have finished class 1 NIC, right? So which will be, oh no, we haven't finished class 1. We'll be doing it. It is the last part of this lecture, the NICs. But there are different types of NIC. Okay, class 1, class 2, class 4. Class 1 is for the employees. Only employees has to deal with class 1 NIC, not any other. Since we are in the employment income, our focus will be only on class 1 NIC. 1 and 1A. 1A is employers will pay that. That's for benefits. We'll not talk about it now. But class 1 NIC. In UK, everyone pays NIC on top of the income tax. It is not only income tax, NIC, National Insurance Contribution. So here, class 1 will apply where the shares are quoted. Why? Because you can convert them into cash. Shares are quoted means easily you can convert it into cash. That's why. Class 1 NIC are paid by both employee and employers. We are focused on the employees part. Because our topic is what? Employment income. Next, if it's a tax advantaged, then when you are exercising the option also no tax. Please go through this table to understand share schemes and option better. Very important. But for a tax advantaged enterprise management incentive. Later on, we'll study this EMI in detail in this lecture. Okay, it's a tax advantage schemes. Okay, known as EMI, enterprise management incentive scheme. Okay, here for this type of schemes, there will be an income tax charge when you exercise it also. If the options are issued at a discount to the market value at grant, that means when you're granting, you are exercising this option at a discount to the market value, not at the market value. Then income tax will arise when you're exercising the option. Otherwise, no. When you're disposing the share, what happens? See, when you dispose shares, capital gain arises. We haven't yet gone to capital gain. We are still in the income tax. Capital gain, CGT tax, is our next category of tax. But very briefly, no, when you're selling shares, it's to do with any type of capital nature of goods when you're selling. Then whatever arises is known as capital gain. It is not a profit then. Then we don't calculate income tax on that. Then there's a CGT tax. We haven't touched it yet. Okay, so sale proceed, this is how you calculate. From your sale proceed, you deduct the market value at the exercise date and you get a gain. We'll see what is this. There's a note for the special note in the next slide. And if it's a tax advantaged, this is how capital gain differs. Capital gain still arises when you dispose share, but it's different. Sale proceed, same, but you deduct cost of option and cost of share. Here you have two gains, 1 and 2. Because it's tax advantaged, it will be having more gain. We'll see what is this note 1 and 2. Note 1, business asset disposal relief. See, when you are disposing a business asset, you are going to get a relief. This relief is known as business asset disposal relief, BADR, or you can say BADR. This will be available if certain conditions are satisfied. Number 1, company has to be a trading company. Number 2, employee has to own greater than or equal to 5% interest in the company. And employee has to own these shares for at least 2 years. They can't give up on the shares, can't dispose the share before 2 years. Then they will not get this relief. Number 2, for EMI scheme, still it's a business asset disposal only. Okay, there is no requirement for this 5% holding, and the 2-year ownership period, when you're counting it, it is counted from the day the option was granted, not when the shares were acquired. It is giving you more flexibility, right? Usually we calculate from the date when the shares were acquired, that ownership period. But here they are telling you under EMI scheme when the option was granted. Don't worry if you have not understood till here, because we are going to cover these EMI schemes in depth. Now let's do a small question. Test your understanding 6. You have to explain the tax implications for Alan of the scheme, assuming it is tax advantage or non-tax advantaged under both. So first, let us see. Alan is employed. It's a trading company. On 1st of July, he was granted the option to buy 1,000 shares for 2. That was the market value at that time. He exercises the option on 17th October when the shares were worth 4.5. He sells them for 5. Shareholding represents less than 5%. Okay. Now, first let's assume it's tax advantaged. So as we know, when it's tax advantage, okay, there are 3: grant of option, exercise of option, and disposal of share. When you're granting the option, no tax. Okay, and it is non-tax advantaged. Here also no tax when you are granting the option. When you are exercising the option, no tax because it's tax advantaged. But under non-tax, if it was non-tax, when you're exercising, you have to, there is a tax. How much is the tax? Market value minus the cost. So 1000 into, what was the market value at the exercise? What is the exercise price? 4.55. 4.5. And the cost of the share was 2. So it is 2500. This 2500 will be taken as an employment income. If it was non-taxed, it will be taxed. Okay. Subject to both income tax and NIC. It will be income tax, NIC. It will be charged to both. Coming to disposal of shares. When it's disposed for tax advantaged, see in the earlier slide, they have given, right? It will be sale proceed minus the costs of the option. So sale proceed was 5000 because they have sold for 5 each and 1000 shares were there. Deduct the cost. Cost was 2000. 2 each, so 2000. So 3000 is the chargeable gain, CG. And on this 3000, okay, you can claim BADR, Business Asset Disposal Relief, if it is an EMI scheme. Because we don't know which scheme. They have just mentioned generally scheme. If it was an EMI scheme, okay, there is no requirement to hold it. That 5% requirement is not there. That you have to hold of greater than 5% interest. And the options were granted at least 2 years before the disposal of shares. It's correct. It was given in 2019. It was granted and was selling it on 20th October 23. So more than 2 years. Alan works for the company because he's employed and it's a trading company. So in this case, this will be available. Now, moving to non-tax. If it was non-tax, again CGD will apply. But this is how it will be done. Sale proceed is 5000 minus market value at the date of exercise, which is 4500 because 4.5 into 1000. So 500. This is the gain. And here you can't claim for BADR. This is not applicable if it's non-tax advantaged. Because Alan does not hold greater than 5% interest. And even does not own the shares for at least 2 years. That means when he exercised the options, he exercised it on 17 October and sold it 20th October. 3 days later he sold it. So he didn't hold it for 2 years. Okay, so these are the tax implications. So from share options, we are moving towards share incentives. Share incentive is like you are gifting shares to the employees, or you are allowing them, the employees, to buy your shares at a discount. When this happens, employees will include the share incentive in their taxable earnings. So value of the shares less price paid, if any, for the shares. And in your ATX exam, remember, if shares are quoted, they are readily convertible. And so this amount will be liable to class 1 NIC. So you have to see whether shares are quoted or not quoted. If quoted, class 1 NIC will apply. If not quoted, it will not apply. But I'm assuming mostly they will give you quoted shares so that they can test your knowledge of class 1 NIC also. Where shares are not quoted, NIC will not apply. Now, next subtopic. So from the share scheme, we are only focusing on tax advantaged share scheme. We are moving towards tax advantaged share scheme. There are 4 types of scheme. 4 types of scheme that receives a favorable tax treatment, which one should know. You should know the similarities between the differences between these 4 schemes. And out of this 4 scheme, you might get any one scheme. They might test. This is also a very tested area because it helps in terms of tax planning. Okay, in ATX, you can expect one question from this area. So, first one is savings. It is SAE, which stands for Savings Related Share Options Scheme. Next is CSOP, Company Share Option Plan. Third, EMI, Enterprise Management Incentive Scheme. We were just talking about this. And Share Incentive Plan. Okay. So now let's quickly go through this table. Participation. If it is CSOP, share option plan, company share option plan, employer chooses who they will give this scheme to, the options to. Under EMI, again employer chooses. But SAE, save as you earn. Employees will decide no, how much they want to save. So it is employees who decides, all employees participate in SAE. Coming to maximum value. Maximum value for CSOP is 30,000 per employee. EMI is 250,000 per employee. Okay. The maximum of the scheme is 3 million. Beyond 3 million, it can't go. And for SAE, it is 500 per month. Exercise period is 3 to 10 years, up to 10 years for EMI. And SAE is 3 or 5 years. See, please understand the difference. Up to 10 years and 3 to 10 years. There's a difference. And 3 or 5 years. What is the difference? For SAE, either you can save for 3 years or 5 years. There is no 4 years. There is no 2 years. There is no 6 years. It's not 3 to 5. It's 3 or 5. Either you keep it for 5 years. Either you keep it for 3 years. Or issue price. Market value. Again market value. To avoid ITIT's income tax charge on exercise. You issue this at market value. Because if you issue this at discount, you are going to you have to pay income tax. But if you issue it at market value, then you don't have to pay income tax when you're exercising the option. Third, remember, your issue price should not be less than 80% of the market value. It can't be. It has to be more. Now, SIP. Here, all employees participate. Share incentive plan. Maximum value is 3,600 per year. And for partnership shares, you can purchase partnership shares also. Any cost. Okay. So allowable deductions against employment income. Okay. Max is the lower of 1,800 and 10% of salary. Awarded matching shares. Maximum 2 per partnership share. Dividends. Tax free if invested in further shares. Holding period is 5 years for full benefit. And base cost of shares is market value when removed from the plan. Definitely with questions you will understand it better. But just go through it roughly. Now we are going to go in depth in all these 4 schemes, how each scheme operates. So here, starting with the SAE, save as you earn. Keep in your mind a picture that this is for employees participate. They have to save. This is how the scheme operates. 500 per month into the SAE scheme for a period of 3 or 5 years. Interest on that scheme is exempt from income tax. Why? Tax advantage, that's why. Because if you keep anything on that scheme, you might be getting interest, right? It is exempt. At the end of the scheme, the money can be used to exercise the share options. Or employee may just withdraw the money for personal use. Anything is fine. As a tax advantage scheme, there is no income tax on the grant or the exercise of the option. We have just seen in the previous few slides, right? The tax advantage scheme, when you grant the option and exercise the option, no income tax. But when you're disposing the share, capital gain will arise. Now, these are the conditions for the scheme. All employees has to participate on a similar terms. But it is acceptable. You might exclude some employees, maybe let's say who have not worked for a certain amount of time, right? You might say a qualifying period. If they work less than that, for new employees, you might not start the scheme. as the period chosen does not exceed 5 years. Now, the purchase price of the share is usually met by the employees out of the SAE accumulated savings. How do they purchase the share? What they have accumulated in the SAE, they pay from there. Okay, it is made by the employees only. Next, the price at which the options are offered is not less than the 80% of the market value of the shares when the options were granted. Remember this 80% rule. And any cost of setting up such a scheme are allowable as trading expense for the company. Company can claim this all the schemes that they've invested. There is some cost, right? So a company as a trading expense, they can deduct these expenses. This is for the company. Then next, CSOP. This is different from SAE schemes. How? Aggregate value of the option is much higher than SAE here. And company has a greater discretion here. They can choose. They have a say in how they want to allocate options to employees. How the scheme operates. Company grants the employees the right to buy shares at some time in future at a price fixed at the time the option was granted. Sometimes later, employee will pay the required amount and the shares are issued to the employee. As a tax advantage again, no income tax will be charged or NIC on the grant of the option. Even when you're exercising the option also, there is no income tax. But when you're disposing, same like SAE, save as you earn, capital gain tax will arise. Now, here for this scheme to operate, the eligible, not all employees are eligible, okay? Eligible employees must be full-time director or full-time or part-time employees. They must at least work for 25 hours per week, not less than that. Then for close company directors, what is this close company? This I will cover maybe not now, towards the end of the ATX syllabus. Close company is a big chapter that we have in ATX. So that time I will explain you what does this close company means. For now, understand close company directors who have a material interest, that means greater than 30%, are ineligible. If anyone is having a material interest in the company greater than 30% shares, they are ineligible for the scheme. Okay. Option must be exercised between 3 years and 10 years of the grant. And again, the price payable for shares should not be less than the market value at the time of the grant. And there is a 30,000 limit to the value of the shares for which a participant may hold unexercised options at the time. Employees owning more than 30% of the company are again ineligible to participate. Cost of setting up such a scheme are again allowable as training expense. This is same like SAE. Most of the things are same. Participation in the scheme need not be extended to all employees, nor be on equal terms to all participants. Yes, you should not explore. It need not be extended to all employees, nor it should be on equal terms to all employees. Now, third, EMI. So EMI, okay, how is this different from, even this is similar to CSOP, but this is available for certain employees, not all employees, okay, and it is for smaller companies. It is granted to selected employees in smaller companies, and rules are also more generous also than company shop and plan. How the scheme operates, it is for selected employee and it's up to 250,000 you can grant. Next, no income tax or NIC on grant, and when you're exercising also no income tax if the option price at the time of the grant was equal to market value, but if it was at discount, then income tax will arise for EMI. And So let's see what happens if the exercise price was granted at a discount. Then the charge is based on the difference between the market value at the time of the grant and the exercise price, if any. Then what about the capital gain tax? The capital gain tax base cost of the share is the price paid plus the discount, if any. That has been treated as an income on expense, income on exercise. And when you are selling the share, the period for which the option is held can be counted as part of the 2-year ownership period for business asset disposal relief. Okay. When you're counting the 2-year period ownership, see, for business asset disposal relief, this for EMI scheme only. You have to calculate 2-year ownership. You have to own the shares for 2 years. So when does this start? 2-year ownership starts. It starts from the date when you're holding the shares. Okay. The period for which the option is held can be counted as part of 2-year ownership for business asset disposal. That means from the date the ownership has been granted, not from the date when you have exercised, till the date of the sale. These are the conditions. There is no limit on the number of the employees who may benefit from the scheme. But the total value of the option granted is 3 million. Qualifying companies, okay, they must have less than 250 full-time employees, and employees should work for the company at least 25 hours a week or at least 75% of the employees' working time. And they must not have a material interest. Material interest means greater than 30%. The company must be a qualified trading company. Certain trades like property development, they are not included in trading company. Okay, they're excluded. The company's gross asset must not exceed 30 million. So an employee may be granted options over shares worth more than 250,000 at the time of grant. Options granted under a share option plan must also be taken into account. See, when you're granting an option under the CSOP, company share option plan, that also you have to take into account when you want to operate EMI. Option must be capable of being exercised within 10 years of grant and may be granted at discount or premium. The company must not be a 51% subsidiary or otherwise controlled by another company and persons connected with that company. Why? Because when you control, then you can't take part in share option scheme. If you are a 51% subsidiary, or if you are controlled somehow by another company or a person connected with that company, then the scheme will not apply to you. Next, the last one, share incentive plan, SIP. This scheme gives the shares to all the employees without an income tax charge. Okay. On disposal, capital gain tax will arise. How the scheme operates? Operates in 3 different ways. An SIP can involve employees acquiring shares in 3 different ways. First way, employer may gift up to 3,600 shares to the employee each year. Usually this amount that is received is dependent on the performance of the company, financial performance of the company. These are referred to as free shares. Okay. Every year, employee might get 3,600 shares as free shares. Okay. Second way, depending on the specific scheme, employee may be, okay, not 100%, they may be allowed to buy up to 8,000 of partnership shares. Remember, the cost is deducted from the employee's pre-tax salary up to a maximum of 10% of salary. Third way, depending on the terms of the specific scheme, employer can choose to issue further free shares on a 2:1 basis. So let's say if the employer buys 1,800, employer may issue a further 3,600 of shares at no cost to the employee. These are referred to as matching shares. Not all schemes offer partnership or matching shares. Remember this. Now, what about dividends? Dividends that an employee receives from the shares from this plan, they can be reinvested tax-free in further shares. Okay, and there is no limit to the amount of dividend that you can reinvest in the share incentive plan. So because it is tax advantage, again, no NIC, no income tax on acquisition of shares. But when you're disposing the share, capital gain tax will arise. This is common for all the schemes. Capital gain tax will arise on the disposal of shares, and you have to calculate. These are the conditions. The plan must be available to all employees or a group company. However, employees with less than 18 months of service can't go for the scheme. That means 1 year and a half, 1 year, 6 months. They have to be there. This plan should have no arrangements for loans to employees, and the shares must be held for at least 5 years. Otherwise, that tax-free advantage they will not get. Next, these are the consequences of the value received. Okay, shares held in the plan for 5 years, shares held between 3 to 5 years, shares held less than 5 years. We'll see under this three scenario what is the implication on income tax and NIC. Let's say the shares are held in the plan for 5 years. Then, if free, it could be free, it could be partnership or matching shares. If they are held in the plan for 5 years, there is no income tax or NIC at the time when the plan shares are awarded. And dividend income that is used to acquire shares is tax free as long as the shares are held in the plan for 3 years. Next, if shares are held between 3 to 5 years, then income tax and NIC will be charged at the lower of initial value of the shares or value at the date of withdrawal, whichever is lower. Last, shares held in the plan for less than 3 years, definitely you have to pay income tax and NIC on them when they cease to be held in the plan. Capital gain will arise. Okay, if employees take the shares out of the plan and sell them later, there's a capital gain arising on the increase in the value after the shares were withdrawn. So to calculate the gain, you have to take the cost of shares, the cost of the shares, their value when taken out of the plan, and if the shares are sold on the same day, what happens? If the shares are sold on the same day they are taken out of the plan, no gain will arise. No gain will arise. Next. So to choice of tax advantage scheme, there are some key factors that you need to consider. You have to match these conditions of the scheme with the employer's requirement. First one, does the employer want to reward it to all employees or just some key employees? Second, what size is the employer's business? Third, remember EMI is only for smaller companies. Does the employer want to offer shares or offer share option plans? How much does the employer want to offer? What holding period for the shares or the option does the employer wants to impose? Depending on this, you will choose the scheme. So now let's do a question. Illustration 5. Here you have a share option, company share option plan, CSOP. You have to compare the impact of tax advantaged and non-tax advantaged scheme. Okay. So here, part A, you have to prepare a table of the tax charges and B, overall net cash position you have to show, including the preferred option. So let's see, annual salary 60,000. Okay. See, they will always give you an amount of salary. The reason is you have to identify whether he's a basic level rate payer or higher rate or additional rate taxpayer for that to decide on your income tax percentages. That's why. So looking at 60,000, it's more than 37,700, so he's a high rate taxpayer. That means his income tax will be at 40%. NIC is 2% for higher rate additional. And capital gain tax will be at 20% in order for you to decide that. Now, let's see. Cost of the option is 5 pence per share. There are 10,000 shares. You can acquire them for 1.6 per share. You can exercise them after 3 but before 10. Claire will exercise her options in November 2023. Market value at the exercise date was 3.8 and shares are sold for 4.2. And she have utilized her annual exempt amount. Okay. This is for capital transactions they have talked about. So now, how are you going to solve this question? When you do this question on your CV platform and your computer, you have to do it on a spreadsheet. Okay, Excel. So you need a column, 3 column. One is non-tax advantaged. The other one is tax advantaged. And the other one is type of tax, income tax, NIC, capital gain tax, and the total. Remember, if it is taxed, there will be no income tax and NIC. You will only have CGD at the disposal of share. But for non-tax, you are going to have income tax and NIC when you exercise the option. So now let's do that. You have to come back to this table. This is part A, tax charges. Part B is the net cash position. Here also you need the 3 tables. Non-tax, tax. So net cash is your receipt, okay? Receipt on disposal. Then less cost to acquire shares. Because you have to pay in cash and also you have to pay the tax. Less tax. And whatever is remaining will be your net cash position. Net cash flow. Receipt on disposal and cost to acquire you can calculate right now, but the tax part you have to first finish your part A. Okay. So now, looking at this, receipt on disposal, you have sold it for 4.2. So 4.2 into 10,000 shares is 42,000. So whether non-tax or tax, your receipt is 42,000. And how much cost to acquire the shares? Cost of the option is 5 pence. Cost to acquire is 1.6. If you add, it will be 1.65. So you can do it together or separately also you can do. Like 5 pence into 10,000, 1.6 into 10,000. Like that also you can do. Okay, so this will be 500. This will be 16,000. Together it is 16,500. Under both is 16,500. The only difference will come in the tax. That we have to calculate. Okay. So first, we'll finish with the non-tax. If it's non-tax, when you're exercising the option, okay, this is the method, the slide. Remember that table always. Market value at exercise date. At exercise date, market value was 3.8. It's here. You see, 3.8. So it's 10,000 into 3.8, 38,000. Deduct cost of option, cost of share. Cost of option is 500. Just now we have calculated 5 pence into 10,000. And cost of share 16,000 or 0.6 into 10,000. You are going to get 21,500. Okay. Your income tax on this will be at 40%. 8,600. And NIC will be 2%. 430. This is what you're going to write here in this table. 8,600 and 430. Now CGD you have to calculate for both. Okay. How are you going to calculate CGD? Sale minus market value at the date of exercise. Sale is 42,000. Market value is 38,000. 4,000. And on this 4,000, you are going to pay 20% because you are a higher rate taxpayer. You have utilized your annual exemption amount. So it's 800. So your CGD will be 800 if non-tax. Now you can add the total 9,830. And when you are taxed, your capital gain tax will be sale proceed less cost of option less cost of share. This is a fixed method. Okay, it was there in the table in the slide. 25,500. This will be taxed at 20%. 5,100. Okay, so this will go here. CGD. So the total tax here, as you can see, how much tax you have saved. Okay. Here you will write the same amount of tax. How much tax did you pay here? 9,830 and 5,100. So the net cash position is also higher under tax advantage. Here is 20,400. Here is 15,670. Net cash flow. So how much, if you calculate the difference between these two, the difference is 4,730. Right? How are you getting this tax advantage? If you check the tax also, this too, you are saving 4,730 of tax. There is another quick method you can do this. If the requirement asks you, okay, here the requirement did not ask you that. That's why you don't have to do that method. But in case the requirement was like this, that they ask you to calculate tax saving or cash benefit of this CSOP scheme, you can calculate this answer very quickly using margin. How? Tell me. See, this employment income, right? 21,500. Okay. Here, you have to find the differences in the tax. This will be taxed to 20%, no? This will be taxed at 20% CGD instead of 42%. If you have used the CSOP scheme, this is on the non-tax advantaged schemes value, the employment income. I'm doing this. You have to do it like that. How? this would have been taxed at 42% if it was not tax advantage. But if it was tax advantage, it would only be taxed at 20%. How 42? 40% income tax and 2% NIC. Together it makes 42%. But now only 20% you have to pay if it was tax advantage. So how much tax you can save? 21,500 into 42 minus 20%, which is 4,730. You see, you're still getting this amount of tax saving only. So that's it. Let's go to lump sum payments on termination. What happens when you're giving a lump sum payment? Lump sum means a huge amount you are giving at once when you're terminating an employee. How do you account for it? From tax, it might be partially exempt, fully exempt, or fully chargeable. Okay. This tax treatment of this lump sum payment depends, okay, whether the payment is a genuine redundancy payment or not. So this table will help you a lot. Okay, if it's wholly exempt. Which type of payments are wholly exempt? Let's say statutory redundancy payment. The payments that you're receiving from government on termination are exempt from tax. Payment for injury, disability, death, exempt. Wholly exempt. Payments made to pension scheme, wholly exempt. Lump sum payment from a registered pension scheme, exempt. Partial exempt. Genuine discretionary. See, often this is tested in exam. Okay, the genuine discretionary, that is ex gratia termination payment, up to 30,000 is exempt. Okay, remember this limit of 30,000 will be reduced further if you are given statutory redundancy payment. Let's say your statutory redundancy payment is 20,000. Then your ex gratia payment only up to 10,000 will be exempted. The balance will be taxable. Wholly chargeable. Any payment which is contractual, example restrictive covenant, are chargeable. Thus you are making a payment due to contract, chargeable. Any other payment that you have received which is expected, like usual employer practice, like gardening leave, customary payment in lieu of notice, they are wholly taxable. Now, genuine ex gratia termination payment, it includes this: redundancy payment, compensation for loss of office, some non-contractual payment made in the notice, made in line with the notice, damages for any breaches of contract or wrongful dismissal. These are the taxable amounts. Okay, so the taxable amounts are taxed in the year of receipt, paid net of payee if paid before leaving, and P45 issued. P45 is for benefits when you are leaving. Okay, and paid net of 20, 40 or 45% of income tax if paid after leaving, and P45 issued. P45 is a letter which is issued when you're leaving, and this is taxed as the top slice of the individual's taxable income. After dividend income you tax this. Okay, why? This will preserve the preferential dividend tax rates. So after your non-saving, savings and dividend is taxed, after that you will tax this lump sum payment in your income tax table. For NIC purpose, any discretionary payment up to 30,000 is exempt from NIC also. Okay, but anything above 30,000 will also attract class 1A NIC. Why 1A? 1A is for benefits. Okay, remember, class 1 and 1A are different, two types of classes on which you have to pay NIC. One is for cash payment, 1A is for benefits only, which is not cash. So this is subject to class 1 NIC. Now, Pilon is payment in lieu of notice. They do not qualify for 30,000 exemption. Whether they are contractual or not, doesn't matter. So therefore, Payment in lieu of notice are subject to both income tax and class 1 NIC. And they are not contractual. Okay, so the payment in lieu of notice that are not contractual or usual employee practice, they need to be split in two elements. First element, amount which would normally be received if the employee had worked his or her their notice period in full. Then that amount is subject to income tax and class 1 NIC. And any remaining amount will be exempt from class 1 NIC, but it is subject to income tax and class 1 NIC only to the extent that it exists 30,000 exemption. If you are not understanding this right now, don't worry. With calculations, you will understand this better. Then always come back and see and read whether it's making any sense or not. Now, benefits provided following the termination. Note, the first 30,000 exempt rule may also apply to any benefits received also. If you receive any benefit, still this 30,000 exemption rule applies as a part of the termination package. Maybe in the termination package you are receiving some benefit also. Even this 30,000 is counted there. Let's say company car you are receiving, not the entire amount is cash. Next, then the value of the benefit is calculated using the employment income rules. List price into, if it's a company car, list price into appropriate percentage. We have done it. Employer then will continue to pay class 1 NIC employer. Employers only pay. Employees do not pay class 1 NIC. They will continue to pay class 1 NIC and value on the value of the benefit. Don't worry. The next topic, the last subtopic in fact of this lecture is NIC. There you will understand what is this class 1 NIC, class 1 NIC and all, and who will pay what amount. Retraining, counseling or outplacement services are exempt benefit. Okay. Before we move on to unapproved retirement benefit, let us do question. Test your understanding 7. Okay. You have to calculate her income tax liability. So she have received an ex gratia lump sum of 80,000. She has remuneration of 35,000. 2745 and dividend received 1,000. This is a furnished accommodation, okay, income from furnished accommodation, and also receive 5,000 statutory redundancy pay. So now, remember from the exempt 30,000, this 5,000 is to be deducted. So now she'll be left with 25,000. This 25,000 you can deduct from this lump sum. This 25,000 will be tax free. So from 80,000, 25,000 you deduct, it says 55,000. This 55,000 will be taxable. This 55,000 you will add with 35,000 of remuneration, this one. Which is 90,000. Okay. So this 90,000 is employment income. Then property income is anything from income from furnished holiday is property income. Do not add it with employment income. Always show separately. You have to classify the types of income. That's why in employment income we are studying separately as a whole. We are not studying all the non-savings income under one topic. No. Employment income is separate, self-employment income is separate, property income is separate, then dividends. We are going back to our previous lecture where we have calculated income tax with various types of income. So the total income TI is 93,745. Deduct personal allowance. It's less than 100,000. How much? 12,570. Do not forget the personal allowance. This is your lecture 1. 81,175. Taxable income TI. Now, remember this, you need to break up. How? You have to find from this category which is non-savings, savings so we don't have, and what is dividend. Dividend is 1000. Termination payment is 55,000. This 55,000. And then what is the non-savings? That table that you used to do, non-savings, dividend and termination. Remember, first non-savings, then dividend, then termination payment you will charge. Okay. So now, dividend and termination and total. How much is non-savings? From 90,000. See, from here, it's very easy. From this, minus the dividend and the 55,000 termination payment. From 81,175. Deduct 55,000 termination payment and 1,000 of dividend income. Then you will be left with 25,175. Dividend is 1,000. And here, this one is 55,000. Remember, when we are deducting the personal allowance, okay, 12,570, this is deducted from non-savings. And you take the 55,000 out also from there. Okay. No. So when you're doing, this will be taxed at 25,175 will be taxed at basic rate 20%. 5035. Then 1,000 is tax free. It comes under dividend nil rate ban. Then out of this 55, which will follow the basic up to 37,700, right? So 11,525 will be at 20%. 2,305. The balance will be at higher rate. For out of 55,000, 11,525. Then the balance is 43,475 into 40%. 17,390. 24,730. This is the income tax. Unapproved retirement benefits. So, where an ex gratia payment is made to an employee approaching retirement age, HMRC may deem the payment to be made under an unapproved retirement benefit and thereby taxable in full. That means without the 30,000 exemption, entire amount is taxable. Retrospective approval can be given for the sum to be fully exempt. Retrospective means going backwards and changing. Other lump sum payment. Lump sum payments which are paid but not in connection with the termination will be taxable. If they arise due to employment. When an individual is given a one-off payment as an encouragement to take up employment, we have studied this word earlier, right, in this lecture, often known as golden hello. It will be subject to income tax and in class 1 NIC in full, as it is seen as a reward for future services. Next, a payment to compensate an employee for a change of employment terms will be taxable to class 1 NIC and income tax. Now, the last part of this lecture, that is NIC. Even this you should know along with tax. This also was taught in taxation. So this is just a summary of it. It's just a revision of NIC, nothing new to it. But even this can be tested in your ATX along with taxation. So you have to know all the types of NIC. But here we are only focusing on NIC for employees. Okay, that is class 1 NIC. And also the person who will be liable to pay those NICs. NIC for self-employed individual will be covered in the self-employment income lecture. That's my next lecture. Next. So, class of contribution. Okay, class 1. There are two types of class 1 NIC. One is primary, one is secondary. And one is class 1A, that is for benefits. Here, we take a percentage, and so it's a percentage based contribution based on employee earnings in excess of 12,570. An employee having an income of more than 12,570 will apply a percentage on it. And the person liable is employee. Next type is class 1 but secondary. Who will pay this? Employers will pay it. Okay. And the basis for assessment of class 1 secondary is same like class 1 primary. It's a percentage based. But for earnings in excess of 9,100. And for class 1 secondary, because employers are paying it, they will get a relief. Employers can get a relief up to 5,000. They can offset this against their class 1 secondary NIC. And finally, class 1A NIC. This is also percentage, but on all the taxable benefit of the employees. It's on benefits. An employer. So if you have seen the three types of NIC, only class 1 primary is paid by employee. Class 1 secondary and class 1A are paid by employer. Okay. Now, starting with class 1. It arises if you are employed in UK and you are age 16 or over and have earnings in excess of the earnings threshold. If you're having earnings in less than the threshold, you don't have to pay NIC. Primary. So class 1 NICs are paid at 12% and 2%. This is calculated as a percentage of gross earnings with no allowable deductions. And if your earnings threshold is less than 12,570, no liability. And class 1 contributions at the rate of 12% are paid on earnings in excess of the threshold. But below the upper earnings limit, it has to be from 12,570 to 5270. If it's above 5270, rate is 2%. And class 1 NIC are calculated on an earnings period basis. If paid weekly, you have to divide it by 52. Then that rate that you are taking, it will be 152 of the limits. And if it's monthly, then you have to divide it by 12. Whatever the limit that has been there on the earnings period, if it's weekly, divide by 52. If it's monthly, divide by 12. But in exam, we use annual limit. Okay, so it is acceptable to calculate the liabilities on an annual basis. class 1 contribution cease. Remember, employee class 1 stops when employee reaches the state pension age. For men, it's 65. It's 65 for both men and women. Okay, from 2018 onwards. Employer is responsible for calculating and accounting for the employee class 1 contributions to HMRC under the pay system. How we deduct income tax for employees under the pay system? Even NIC will be deducted like that, class 1 NIC. So, the gross earnings on which class 1 contributions are calculated, they comprise of remuneration, okay? It could be either employments are paid in cash or assets, which could be easily convertible into cash. Mostly it's cash. Then, gross earnings has wages, salaries, overpay, commission, bonus. Sick pay is also there in that gross earning. Then tips are there, and gratuities paid or allocated by the employer. Then payment of the cost of travel between home and work, or any profit element where business travel is reimbursed. It also comes under gross earnings. All this you have to add. For example, let's say the mileage allowance that you have received is in excess of the HMRC approved rate of 45 pence per mile. Then the excess above 45 is subject to class 1 NIC. Now, it includes bonuses made by using financial instruments such as shares, unit trusts, options, gilts, gold, precious stones, fine wines, ready convertible assets. Remember, how do you know it is readily convertible? If arrangement is there in the place for it to purchase. Remuneration in a form of cash or non-cash vouchers. Okay, we have M&S voucher, that is Marks and Spencer vouchers. Remuneration could be in a form of cash or non-cash vouchers also. These are not taken as gross earnings. Benefits. Why? For benefit we have class 1A. We don't include benefits here under gross earnings. And even redundancy payment, we don't. Payments of any pension, you do not include in gross earnings. Next, coming to employer's secondary contribution. Here, for secondary, employers pay 13.8%. It's fixed, okay? 13.8% on gross earnings above 9,100. And the contributions are a deductible expense for employer when calculating taxable profit. See, contributions that employers are doing here, they can deduct this when they are calculating their taxable profit. There's no liability if earning is less than 9,100. Okay. So where earnings exceed the threshold, contributions are paid on the excess. There is no reduced rate when the earnings exceed the upper earnings limit, unlike how we have for the primary contribution, where it was 12% and 2%. Here's nothing like that. Here it's 13.8% only, whatever the amount above 9,100. Okay, and there is no upper age limit also for employer class 1 contribution to cease. There is no age limit. Okay, so but remember, this employer class 1 contribution ceases when the employee leaves the employment. Okay, there's no upper age limit. Age limit is not there, 60 and 65 like that, how we have for employees. The employer is liable in full even if the employee is above the state pension age. Remember, employer will be liable in full. Next, talking about NIC employment allowance. Employers are able to claim up to 5,000 relief. Note that the allowance, you cannot use it against any other class of NIC, only this class. You can't use it against class 1A. And it is claimed through the real-time information pay system. The employment allowance is only available to employers whose employees class 1 NIC liability was below 100,000 in the previous tax year. Only they can claim this. The allowance is not available to companies where a director is the only employee earning over 9,100. Remember this. If you are the only director is also an employee, right? Okay. And they are earning over 9,100. Then this allowance you can't claim. Coming to class 1A contribution. Okay. This is for taxable benefit. Employees are required to pay. And there is no class 1A charge in respect of any benefit that has been already treated as earnings for class 1 contribution, like cash vouchers. Okay. If you have taken any benefit and it is treated as a earnings for class 1 contribution, you can't charge 1A on that, like cash vouchers. Cash voucher is a benefit, but it has been taken as an earnings for class 1 contribution. Rate is same like employers class 1 contribution, 13.8%. So in this way, it's easier for you to remember that employers have to pay 13.8% only. And these contributions, you can deduct them as an expense for the employer when calculating their taxable profit. Now, employees reaching state pension age. What happens? An employee who continues to work after attending the state pension age has no liability for employee class 1 NIC contribution. Employee might reach a state pension age, let's say 67, 68. They're still continuing to work, but then they will not be liable to pay class 1 NIC. Only up to state pension age they are liable. But employer is still liable for full employers class 1 NIC. It's binding on them. Okay. Now, deduction and payment by the employer. Remember, employer, they calculate both the employee and the employer's class 1 contribution at each weekly or monthly pay date. You have to remember this date very well, when it is paid, which month. So at the end of each pay month, that is the 5th, month 5, okay, the total contribution becomes payable along with income tax, deducted under payee. Even your NIC is deducted under payee, how income tax is deducted, and they are paid at the same time, not later than 40 days thereafter. So from 5th, if you take 14 days, it will be 19th each month. However, because now businesses are paying electronically, they are allowed extra 3 days. So in short, payday is 22nd of each month for NIC. 22nd of each month. That's why I have highlighted it in bold for you to remember. Even class 1A contributions. This also will be paid, but this will be payable annually. Okay, to HMRC by the 22nd July following the end of the tax year. After the tax year, it is not before the tax year ends, after the tax year, following the end of the tax year, 22nd July. Remember this date. If it is class 1 contribution, 22nd of each month, class 1A contribution, 22nd July following the end of the tax year. Now, what about person with more than one job? See, a person with more than one job is separately liable for class 1 NIC for each job, falling within the scope of class 1 contribution. That means earnings more than 12,570. Let's say he has 2 jobs. From both the job is earning more than 12,570. He has to pay class 1 NIC for both the jobs. And for employer, each employer is also separately liable for employers class 1 NIC. So the total employee class 1 contributions from all employment is subject to an overall annual maximum. Now, employees with more than one job can prevent overpayment of contribution by applying for deferment of contribution or claiming a refund after the end of the tax year. Either they can claim a refund or they can defer the contribution. Company directors. For company directors, okay, they are deemed to have an annual earnings period. Annual earning threshold and the UL therefore apply. UA is the upper earnings limit. Okay. The rule prevent directors. Why is this rule? Because they prevent the directors avoiding NICs by paying themselves a low monthly salary. A lot of directors do this. What do? They try to manipulate. In order for them not to pay the NIC because they want to avoid, they pay themselves a low monthly salary and then they take a large bonus. So to prevent this from happening, now directors are deemed to have an annual earnings period. Their earnings will be taken annually. An annual earnings threshold and upper earnings limit applies for them. Now, so let's summarize NIC. We have finished the syllabus. The entire lecture is over right now. Okay, so class 1 is paid by employee, payable on gross cash earnings. Okay, remember the word cash earnings. No allowable deductions. It includes vouchers, payable when 16 till state pension age. Rate is 20% on earnings between 12,570 to 5,270. Above 5,270 is 2%. Due date is 22nd of each month and is payable under payee. Okay. Class 1, same gross cash earnings. Here also no allowable deduction. It includes vouchers payable age 16 or over. There is no limit. They will keep on paying. Rate 13.8 above 9,100. Due date again same as class 1 employee. But here they have employment allowance. That is 5,000 per tax year. It is not there for class 1 employee. Coming to class 1A. Payable on taxable benefit. It excludes exempt benefit and vouchers. Payable age 16 or over. Rate is 13.8%. Due date 22nd July following the end of the tax year. So now let's do 2 questions before we come to the summary of this lecture. Illustration 6. So in illustration 6, you have to calculate class 1 employee NIC for Janet if she's an employee or a director. Remember, situation will change. So first we'll calculate under employee and then director. Okay. She is receiving a salary of 18,000 per year. Okay. It's per annum, annually. Whereas she's also paid a bonus of 10,000 in the first week of March 2024. So since this is first week, you can see this is monthly. In 1 month she have received, and this salary is per annum. So you have to break down. You want to know for 1 month how much is the salary. So when we are doing that, we are breaking down each threshold limit to monthly. From annually, the figures which is given is annually. Now you have to break it down to monthly for employee. For director, situation is different. We'll see how. But first we'll finish with employee. So let's quickly do that. Okay. So this 18,000 salary, you will break it down into 12, then it becomes 1,500. This is salary per month. And for 1 month, the bonus was 10,000. That means for 1 month, they must have received 11,500. Okay. Only for 1 month. For the previous 11 months, she has been receiving 1,500 because she's an employee. So remember the threshold which was given annually. What was it? Primary threshold and upper threshold. Primary threshold was 12,570. Upper was 50,270. You need to divide this by 12 because this is an annual figure. 1048 4189. Okay. So as you can see, every year she has been receiving 1,500 for 11 months. 1,500 is more than the primary threshold. But for March, in the month of March, one single month she has been receiving 11,500 with the addition of bonus 10,000, right? So this one is more than the upper threshold also. Now we'll first do for this 1,500. How are we going to do it? 1,500 minus the primary threshold, 1048. We'll apply 12% because anything above the primary threshold is 12% and it's for 11 months only. Now we'll take it, okay, so 597. Then this upper threshold, 4189 minus 1048 from primary upper to primary. This will be at 12%, but it's only for 1 month, okay? See, this 11,500 is exiting the upper also for 1 month. We have finished the 11 months. So that one is 12% into 1 month. 377. Now 11,500 minus 4189 into the additional 2% into 1 month. 146. The total is 1120. Now if he's a director, it will be done annually. Okay, because the period is annual only. She then has to pay her NIC by reference to the total earnings in the year. For director, it's like that. Just now in the last slide we have seen that, right? So annual remuneration, they have to go by annual basis. Otherwise, in the other time when the salary is low, they'll be paying low salary. So the salary was 18,000, bonus was 10,000. Add this together, it becomes 28,000. This 28,000 is more than this one, the primary threshold. You have to take the annual figure. 28,000 minus 12,570 into 12%. You don't have to take into any number of months because it's done annually. 1852. This is a class 1 NIC if it's a director. Now, test your understanding. 8. The last question. Here you have to calculate employees NIC and the total employers class 1 and class 1 NIC. All the 3 NICs are tested. Alex and Shakura. Okay. Alex is paid 14,700, Shakura is paid 57,800. Sakura receives 9,600 taxable benefit. Abdullah's employees class 1 NIC liability was 7,000. First we'll do for Alex. So for Alex, he's being paid 14,700. This is more than 12,570 into 12%, 256. Then this is employees class 1. Then we have employers class 1 NIC, which will be 14,700 minus 9,100. It has to be above 9,100 into 13.8%. This will be 773. Now coming to Shakura. For Shakura, we'll see. Shakura 57,800. It's more than the upper limit also. So first, up to 5270 minus 12,570 is at 12. 4,524. Then 57,800 minus 5270 into 2%. 151. Together it is 4,675. This is employees class 1 NIC. Then employers class 1 NIC for Shakura is 57,800 minus 9,100 into 30.8% is 6,721. Then employers class 1A NIC. How much? The benefit is 9,600. So on this 9,600, just apply 13.8%. 1325. Done. Now coming to the total employers class 1 NIC. So we have to add this one, 773. For employers, not employees. Then we have to take 6721. 7494. We can deduct 5,000 employment allowance. 24. Remember, for employer, he can add all the employees NIC that he's being paying for class 1, like here, Alex and Shakura. And he's eligible for employment allowance only 5,000. Not separately Alex 5,000 and Shakura 5,000. Not like that. You have to add up all the employers class 1 NIC and then deduct that 5,000. So that's it. Now let's summarize the entire lecture. So finally, after long 4 hour, around 16 minutes, we are in the summary of this entire lecture. I know it's very, very lengthy, but trust me, once you practice questions on this area, this is one of the easiest area to score marks. So when you're tackling this, please break this down into bits and pieces. Okay. For example, employment income, one category, share schemes in the other category, lump sum payment in the other category, and study like that. So starting with the entire lecture is employment income. From there, we studied what are the factors that says an income is an employment or from self-employment. There were some 9 factors based on the purpose, equipment that is used, right? Then employment income computation, that pro forma. What was the basis of assessment? What are the allowable deductions and taxable benefit? Then the termination benefit, ex gratia payment up to 30,000, exempt. Incentive schemes, non-tax and tax advantage. Under tax advantage, we went through company share option plan, enterprise management incentive, save as you earn, and share incentive plan. Please go through all this 4. Then national insurance, NIC contribution, class 1 and class 1A. Class 1 we have primary and secondary. Primary paid by employee, secondary paid by employer. Class 1A is also paid by employer for the benefits. So please make sure that you touch each of this area. If you're not able to complete this lecture in one day, don't worry, break these down into 3-4 days and finish it. And make sure that you, after this, you jump to your revision kit questions and solve questions on employment income, so that you know how to deal with the 4 types of tax advantage schemes. So you know how to deal with the termination payment. So you know what are the allowable deductions. You know how to calculate NIC. You should be knowing all this. So that's it for this lecture. Thank you for watching, and I shall see you in the next lecture. Do not forget to subscribe to my channel if you haven't subscribed, and please, please, please do share the content of my channel among your friends so they know that ATX is now for free. Thank you and take care.